Okay. All right, folks, let's go ahead and get airborne with trading the Death Star, my presentation. Before I begin, hard for me to speak this morning with everything that's going on in Afghanistan with the news of an attack. So if we can just kind of send as much love and light to that region, not only just for Americans trying to get home, but Afghanis and innocent women and children that may have perished in this recent attack. It's devastating. I have a lot of buddies who served in Afghanistan who aren't doing so hot with everything that's going on. So let's keep all those folks in the front of mind. Okay, so the Death Star, folks. If you're old like me, you were young when the Star Wars stuff came out, but I also have 3 kids now and some Star Wars nerds. But if you're not familiar with the Death Star, man, this was this huge, massive battle station that was literally taking over the universe. Almost got blown up and attacked by some folks, but they rebuilt it and became even bigger. And that's the stock that we're going to talk about today, the stock that's literally taking over the universe. It gets attacked every once in a while, but it seems to come through it unscathed. And it's the only stock, you heard me, the only stock you need to own for the rest of your life. Real quick, in my personal accounts, I'm long Amazon, XLY, and Robinhood, but I also have some short calls on those names, so I guess you could say I'm kind of neutral, but those are 3 positions in my personal accounts. Clearly, I come from a military background, so my presentation is going to have a little bit of a military tint to it and a fighter pilot tint. So quick question for you. Which fighter aircraft would you rather fly? I'm going to give you 2 choices here. There's your first choice. Your first choice is an F4 Phantom. Take a look at that. Look at all of those steam gauges. This thing, cool looking airplane, very fast, but look at that, over 300 switches and dials in that cockpit. This was a very labor-intensive aircraft. The pilot would spend a lot of what we call heads down time looking at all this stuff, right? Instead of eyeballs out of the cockpit looking for enemy aircraft, MiGs or surface air missiles, or even AAA, anti-aircraft artillery. So very labor-intensive. Matter of fact, this aircraft was so much work that they put another dude in the back seat just to run the radar. So very labor-intensive, a lot going on. Your second choice is that aircraft. Folks, this is the F-35 Lightning, the Joint Strike Fighter. 2 flat panel displays. There's absolutely not one steam gauge in this cockpit. We call this jet the Wonder Woman jet. It's invisible to radar and it's brilliant. It's kind of creepy, to be honest with you. Why? Because it limits the amount of information that it displays to the pilot at different portions of the flight. The pilot doesn't need to know this right now, so I'm not going to tell her or him. The jet actually is learning how these pilots fly the aircraft and getting smarter. So clearly, if you're going into combat, this is the aircraft you'd want. Very labor not intensive, unlike the F4. What's this have to do with trading? Everything, right? Matter of fact, speaking of Star Wars or the Death Star, that's what the helmet looks like of an F-35 pilot. Matter of fact, when they look down, they don't see the cockpit, they see through the floor of the aircraft. There's so many sensors on this aircraft that it literally is the Wonder Woman jet. All right, real quick, my promise. I'm going to give you an up-to-date intelligence brief because as I'm staring at one of my screens, the S&P just keeps imploding based on what's going on in Afghanistan. So you have to be strategic in your trading. You can't just, I hope you didn't wake up this morning and put on your bunny slippers and take a sip of coffee and just kind of take a look at what's going on your brokerage account without taking a look at what's going on around the world. I've been briefing my traders all week to get long volatility via the VIX and to buy puts on the S&P 500 because I knew something like this was going to happen. And those trades are obviously making money today. Show you the only stock you need to own. You heard me, just one stock, and also a good substitute to trade that you know, it's like cocktails. So my buddy always says that shrimp are a vehicle for eating cocktail sauce. So I'm going to give you a vehicle for eating this one stock if it's a little too expensive for you. So make sure you silence your electronic nicotine and no distractions, because you've never heard what I'm about to tell you. Real quick, as Anna said, my name is Matthew Buckley. My call sign is Wiz. I flew the F-18 Hornet for the United States Navy for 15 years, graduated from the Navy Fighter Weapons School that many of you know as Top Gun, and I also flew 44 combat sorties over Iraq. What's this have to do with trading? Everything. Okay, you don't join the Navy to get rich, you join the Navy to serve your country. But as a young aviator, I applied everything that I was learning as a fighter pilot to my trading. Having a strategy, implementing tactics, contingency planning, knowing when to get out of a good or bad situation for that matter before it got any worse, right? Managing risk. Now you're probably sitting here going, this dude's talking about managing risk and he flew off aircraft carriers over enemy country. Yeah, right? As an options trader, as a fighter pilot, you want to minimize and eliminate all known risk, right? So I applied that to my trading with incredible results. I was always interested in finance in the background, so applying this to my trading worked so well that I popped up on the radar of one of the largest volatility arbitrage options trading firms in the world, headquartered right there in the beautiful Chicago Board of Trade. You see those big vertical windows? That was our trading floor. When I was there, I helped build a hedge fund. I helped build the retail brokerage known as Options House, and also was the managing director of strategy. I also, in my spare time, was the founder and CEO of the Options News Network, ONN.TV. Now, I know John and Pete Najarian from my time in Chicago, good guys. And, on CNBC, they kind of pay lip service to options. It's just not CNBC's forte. So we essentially were the CNBC for options. We would shoot our programs on the floor of the CBOE and the CBOT, giving folks like you a behind-the-scenes look at what's going on in the options market. So no offense to folks from Chicago, but you can keep it, man. I'm a Navy guy. I need a beach and water. February in Chicago, walking from Union Station to the Board of Trade is a survival experience. So moved down here to God's waiting room, known as Boca Raton, and about 10, 11 years ago, and I started Top Gun Options to put the ladder down and show folks how I essentially went from being, so-called part of the smart money, well, actually from retail trader to smart money to training retail traders, right? I always joke that I was Eddie Murphy in trading places, kind of some dude off the street up to the big leagues, and then now back to doing it on my own and teaching people kind of everything I saw. If I learned anything, if you learned anything in 2020 last year, it's that the smart money ain't that smart. Trust me, I've seen the smart money, and most of them are kind of stupid, to be honest with you. What happened last year in the COVID crash? I actually wrote a book called COVID Crash that's going through final editing right now because I nailed it. I was one of the only financial professionals on the face of this planet that nailed the COVID market crash. What happened? The whole way down last January and February, the smart money told you what? Oh, this is the bottom. Oh, I'd buy here. Hell, Donald Trump one day sent out a tweet like, oh, stocks are looking good here, and deleted it the next day as the market went down 3,000 points. I did the exact opposite all the way down. Misery loves company, folks, and the smart money got it completely wrong. I didn't. Also do some charity work down here in South Florida with our local law enforcement. I lost a sister to a drunk driver. I work with MAD, and then I started my own foundation last year called the Top Gun Fighter Foundation to try and minimize and eliminate veteran suicide. This data are old. One veteran per hour kills himself, folks. And based on the absolute horrific, embarrassing defeat in Afghanistan, I guarantee you those numbers are going through the roof. My phone has been ringing off the hook. I've been reaching out to my brothers and my sisters to try and remind them that they are loved and their sacrifices were not in vain. So that's what I do in my free time is to focus on veterans and the plight of veterans. Okay. Those are some of the airplanes that we own in our foundation. That's me and my family. I'm a little older than that, though, now. But let's go ahead and get airborne. if you go to one of these briefs and you don't know really anything about the dude or the lady talking to you, I don't understand how people end up trying to go work with them. So there's me. So anyway, let's go ahead and get airborne. I got some shocking news to you, or maybe it won't be that shocking. Wall Street's lying to you, right? So half of you just said duh, and the other half you said about what specifically? I'm pretty sure they lie to me about everything. Well, folks, anybody ever hear this out of the folks on Wall Street? Hey, you can't put all your eggs in one basket, right? Do not do that. You have got to diversify. Why diversification is important. The 5 steps to diversify. You got to diversify, right? Day one of investing, folks, right? When you hatched, when you were hatched into the investing or trading universe, you were told what? Oh my God, you have to diversify. You know what? Who told you needed to do that? That dude. Anybody ever see the movie Boiler Room? The Wolf of Wall Street, or even the movie Wall Street? Folks, whenever you hear the word broker, I don't care if it's a aircraft broker, yacht broker, real estate broker, or stock broker, they work on, say the word with me, commissions. Folks, they want you in as many names as physically possible. You see Boiler Room? Hey, get everybody into this stock today. And then tomorrow, get them into this one. Well, we just got them into this one the other day. Well, get them into this one today. It's commissions, ladies and gentlemen. Matter of fact, the practice is called what? It's called churn. They churn your account. Commission, 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 right? So, but let's be brutally honest here. So that's how Wall Street worked forever. So if you're sitting here going, well, Wiz, I trade with a broker that doesn't charge commissions. Ladies and gentlemen, if you are ever getting something for free, you're not the customer. You are the product. So if you're at Robinhood, well, I pay no commissions. You're getting screwed some other way, folks. It's called payment for order flow. Okay? So payment for order flow means these like Ken Griffin at Citadel or Stevie Cohen, they are buying your order flow, ladies and gentlemen. So you ain't the customer, you're the product. But let's get back to the diversification thing. This dude lied to you. He wanted you diversified to make money for him. I'm going to be brutally honest. I'm a fighter pilot. I really don't have a filter. I have time for truth. Diversification is for stupid people. Well, that's kind of brutal, Wiz. Well, let me say it a little, or let me quote somebody who's a little nicer than I am. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. That's a nicer way to say it, Wiz. Exactly. Ladies and gentlemen, the only name that you need to be in is Amazon. It's physically diversified in and of itself, which we'll get into in a couple minutes. But I'm a numbers guy. I'm a chart guy. Anybody like that chart? Folks, I never in the history of man has seen a chart that does this. Amazon revenue continues to grow at 30% per year, folks. 30% per year. Isn't this absolutely incredible? I've never seen another company like this. Look at its annual revenue by segment, ladies and gentlemen. I remember years ago, AWS, Amazon Web Services, wasn't even a thing. Now it's a massive revenue source, folks. It competes with the Microsoft cloud, international, North, you name it, folks. Look at that is an incredible, the math when it comes to Amazon is literally insane. Amazon Prime Day, folks, is kind of like an event. People put it on their calendars. I mean, like a couple of years from now, maybe employers give people off days off work to do the Amazon Prime Day, but it's like a thing now, right? It's become a verb. It's like when people go to the post office or UPS or something to overnight something, you still use the term FedEx, don't you? Even though if I send somebody something overnight, I'm like, I'll FedEx it to you. Now, let's talk about something interesting. If you showed me this chart when I started investing, let me black out the name of the stock there and somebody said, hey, Wiz, would you invest in this? I'd be like, all right, well, let me take a look. Sales, oh my God, obscene amount of sales, free cash flow. Okay. Whoa. Profit down here? Ladies and gentlemen, and if you had shorted this stock, you'd be broke, right? Instead of saying I'd be long this stock, old me would have said I'd short it. But let's think about the genius behind this. Ladies and gentlemen, Jeff Bezos has said, if I make $1 in profit, I failed. What do you mean by that, Wiz? What's he mean? He means that if he makes $1, he wants to take that dollar and do something with it. He wants to innovate, buy a competitor, put a competitor out of business, make a new product, buy an airplane, buy a new Amazon hub outside of Miami International. He doesn't want profit. He wants to get rid of it. And this is comical because when you see Democrats scrambling, Amazon needs to pay their fair share of taxes. Coming from people who've never owned or operated a business, they don't understand that. They're like, wait a minute, what do you mean Amazon is not going to get nailed with our massive taxes? Because the dude does a great job of saying, we don't make any money. We reinvest it and make a bigger Death Star. You have got to take your hats off to that type of attitude, right? Jeff Bezos has also said, I'm never going to split my stock, and I'm also never going to have a dividend. He's like, why give money, quote, back to the shareholders? They've given me their money to do great things with it, okay? So I love that chart right there. Old me wouldn't understand it. New me, I'd buy with both hands. Don't listen to me, man. Dave, bought my first Jan 21 2270 call, been rolling short diagonal calls. The base call is worth 51 grand. Parmar sold the Amazon 3000 calls too early last week at 122. I still made 80 grand. Dennis, my original Amazon synthetic call for 621 expiry is now up 145 grand. Kevin, cumulative Amazon gains net out to 12,673, which is nicer than it seems since I started 6K in the hole before following Wiz's discipline correctly. Just great stuff. I love this. Greg, my Amazon long call diagonal is up 28 grand from yesterday to over 31K today. Now, before I just sit here and talk about sunshine, lollipops, and unicorns with just trading Amazon, there are risks, folks. As a fighter pilot, as an options trader, I have to brief you, excuse me, on the potential risks of just trading one name. Anybody hear of a small company called Lehman Brothers or another mom and pop called Bear Stearns? Jim Cramer knows about Bear Stearns. Jim Cramer looked like Khrushchev at the UN. Bald dude frothing at the mouth and slamming his shoe on the table about Bear Stearns is a steal at 70. Remember at the height of the financial crisis? Jim Cramer's like, oh my God, Bear Stearns is safe. You could put your money there. A couple days later, it was at zero. Google that clip, folks. How about pets.com? How about Enron? Folks, Enron didn't even own the building they were in. They were a middleman of electricity. What about pets.com? It owned a domain name, pets.com. What's the common, for the rest of my time with you this morning, I could walk through the graveyard of stocks that go to zero. I'm not going to do that. But what's the common thread usually between stocks that go to zero? They don't own a thing. Folks, a URL, a middleman of electricity, and two financial companies that didn't own anything, folks. They owned paper. They owned contracts. They were on the other side of trades. And when people heard that they might not have enough money on board to cover all the trades, they got a run on them and they were gone in days. So folks, the difference between these stocks going to zero and Amazon is that it's physically impossible for Amazon to go to zero, the stock. Why? Because it owns stuff. You ever drive by an Amazon fulfillment center? The one down in Miami is larger than an aircraft carrier and probably has about as many people scrambling 24 hours a day, 7 days a week. It owns stuff, right? In full disclosure, I flew for FedEx for 10 months when I got off active duty in the Navy, and I was miserable. I could not stand commuting to Memphis at 10 at night to get there at midnight to fly 8 hours and try and sleep during the day somewhere. Why am I wanking about that? I'm not, because I left and went to American Airlines. But I got a call from a buddy, like, when was it? 5, 7 years ago? I forget when it was, but he was in corporate. He's like, doesn't Jeff Bezos own Amazon? I'm like, yeah. He's like, they just leased 5 airplanes. And I was like, oh my God, he's going to do it. He's like, what? I'm like, he's going to put you out of business, man, or at least get rid of you. And they did. Jeff Bezos ain't an idiot. He's like, what's his name? Rockefeller, or no, Carnegie, whichever guy was like, well, I own the oil wells. Why am I watching the oil go on a truck to go to a railroad? Why don't I own the trucks and the railroad as well? So Jeff Bezos is brilliant. He owns things. Now, this guy's gone, but why is he on the screen? Because the other risk to trading in Amazon is political. Anybody remember at the beginning of the Trump presidency, he woke up one morning, or didn't go to bed, depends on who you listen to. He grabbed his cell phone and took a flamethrower to Amazon. Jeff Bezos, Washington Post, Amazon's a monopoly. They're putting the post office out of business. You know what happened? The stock freaked out a little bit. It kind of hid in a foxhole, and then nothing happened. 3 years later, whenever it was, he did it again. He went after Jeff Bezos again in Amazon. They're destroying the post office. What happened? Nothing. A lot of smoke, no fire. Amazon, this, Department of Justice, that, big tech and antitrust and DC Attorney General suing for price fixing. Ladies and gentlemen, nothing's happened. You ready for this? The ship has already sailed. Amazon at this point is like mercury. If you smash it, you break it up into bigger parts. If they tried to get rid of Amazon today, they'd create monopolies in all the little verticals, that Amazon's in. Remember 4 or 5 months ago, breaking news, Amazon just trademarked the words Amazon Pharma. You want a good bearish trade? CVS and Walgreens. 2 or 3 years from now, there won't be drugstores. You'll get a text message that says, go to the front door. You open it, a little drone is going to scan your face and drop your prescriptions into your hand. Folks, everything that Amazon gets into, it ends up taking over. Now, it's huge. But let me tell you something. I wear 2 suits at Top Gun Options. I wear a flight suit, and I'm going to tell you how I feel as an American. I think Amazon's a disgrace. I think Jeff Bezos is a disgrace. The scandemic that shut down small businesses and destroyed them powered Amazon to record profits. It's devastating. I say we shut down Amazon for a year and let all the other companies catch up. That's me. That's how I feel. The world's richest man can't even pay his workers a decent wage. That's how I feel. But guess what? You don't care how I feel. I'm going to put on a $10,000 Armani suit and go, good. He actually should fire all of his workers and replace them with lower paid workers. I mean, I hate talking like that, but folks, my job as a portfolio manager is to be Gordon Gekko. Just like he said in the movie Wall Street, you want a friend, get a dog. I'm going to teach you how to potentially make money, okay? So what are the benefits? Now, I just talked about the potential risks of just trading Amazon. What are the benefits? Well, folks, you're going to trade the same name and potentially profit no matter what direction Amazon moves, up, down, or sideways. You stay focused on the news and events that impact Amazon instead of a bunch of stocks and ETFs. You become an expert in Amazon, reducing time spent on other positions. I have a buddy who's an Apple market maker, and I'm not joking when he doesn't care. He doesn't care. Who cares about the stock market, Wiz, or the VIX or whatever? I eat, breathe, and sleep Apple. He doesn't care. Let me give you a local example. A buddy of mine's an orthopedic surgeon down here, and he, Wiz, I heard you trade, and I need some help. Okay, man. I met him. He booted up his laptop, logged into his brokerage account, turned the screen around, and thank God he's a doctor, because I fell out of my chair and hit my head and passed out. Why? This was his trading platform. This guy who works 10, 12-hour days office hour surgeries. This guy had 33 positions in his portfolio. Ladies and gentlemen, I do this for a living, and I got 4, maybe 5. If you're a retail trader and you got more than 5 positions, you don't know what you're doing. I've been doing this for 31 years, and I know it for a fact. He tried to brief. He's like, I'm like, what is this? He's like, well, I think that one's a pot stock. I don't know, I forget. But anyway, this one, I'm like, you what? You don't? Okay, keep going. Well, this one's like a medical device company, I think. My buddy told me to get into it, and it's down like 50%. You ready for this? He goes, I'm waiting for it to come back so I can get out of it. I'm waiting for it to come back to even so I don't lose money. I'm like, oh my God, Doc, how do you know it is ever coming back? And do you realize that from here, the stock would have to go up 100% for you to break? I'm like, stop talking, Doc. No offense. That's it. You have got to simplify your trading cockpit. There's no way physically possible you can do any of this. You got to simplify and start flying an F-35. You got to focus on one thing that in and of itself is diversified. Now, I know a lot of you at this point go, you know what? He's talking to me. I work, I'm a mom, I do this, whatever it is, and you're going, how can you be an expert in a bunch of different names? At the trading firm I was at in Chicago, we had a research desk. Their job was to own 1 or 2 names, eat, breathe, and sleep it. Now, usually about 4 or 5. You know how many times they got stuff wrong? I'd look at them and be like, your job is to just know this and you don't know this? So what chance do you have if that's not even your full-time job? But anyway, if I'm talking to you, great. If you're sitting here going, Wiz, I'm sorry, man, I still am programmed to diversify. They sunk their teeth into my neck like a vampire, must diversify. Well, guess what? We also trade in this portfolio here at Top Gun Options. We also trade an ETF known as the XLY. Why do we do that? 25, let's just say, a quarter of this ETF is Amazon. There on your screen is your diversification if you need even more than just Amazon being diversified. Tesla, Home Depot, McDonald's, Nike, Starbucks, Lowe's, Target, Booking, TJX. There, for my friends who are diversification fiends, is your diversification. So in this portfolio at Top Gun Options that I manage, technically it's not solo Amazon, even though I call it that, it's both, right? We trade Amazon and we trade XLY, right? Because it's a good proxy. Plus, Amazon's a $3,300 stock, and the XLY is what? A $180 ETF, right? So that just makes sense to do that. So how do we make money targeting Amazon and XLY for max profit? Here's what we do. Every Monday at noon, I do a live solo Amazon brief. So the next one, if you become a new member today, on Monday at noon, I'm going to show you how we establish what I call a base position. I'm going to hop in my F-35 and fly the speed of light out into the future. With options, folks, we can go out a couple years into the future and be bullish, right? So I call that a base position. It's like the Marine Corps, right? Landing and establishing a beachhead. We're going to establish a base position, a bullish base position out into the future. And the tactics are either a synthetic stock or a long call diagonal. Now look in the parentheses there, with protective puts. I never walked out to the F-18, folks, and said, you know what, Chief, pull the ejection seat out of the aircraft. I'm awesome and I don't need any protection today. I'm not going to get shot down. That would have been the day I got shot down. So I'm going to show you how we protect our positions with protective puts. Step 2, after we have our base position bullish in the future established, we're going to trade the front months, right? If Amazon or XLY are moving up, maybe some bullish spreads, buy some calls. If it's going down, maybe some bearish spreads, sell some calls. If it's moving sideways, yes, sideways, folks. There's a tactic where we can make money as an options trader. If it's moving sideways, it's called an iron condor. Okay, let me give you an example of my long-term bullish position on Amazon. Right now, wow, look at the S&P 500 today, man. Woo! Implosion, bounce, implosion, bounce, where did we bounce here? 44.70. What's this? 85. Man, that is an ugly looking chart. So Amazon, right now I am long 7. I am long 7 of the Amazon Jan 23 3,900 calls. I think in a couple years, Amazon's a $4,000 or $5,000, well, $5,000-$6,000 stock easily. So I went into the future and I bought $162,000 worth of Amazon. Check out how I'm making money in the front month. Take a look at Amazon today, though. Wow, look at this. Amazon is seeing a rip your face off rally today, up 26 bucks as the market's imploding. Wow, big counter trend out of Amazon. But look what I'm doing in the front month. For tomorrow, I sold 7. I sold 7 of the 3,300 calls. So this week, not quote, I'm going to show you that I'm bringing in income. Selling 7 of these calls to tomorrow, I am bringing in $8,000 this week in profit in these short calls. Okay, so there's a perfect example. I'm going to teach you what to do. Go out, get long-term bullish on Amazon, and then sell front month upside calls against it. Okay, let's take a look at the options chain for Amazon. Take a look at the chart. So recently, it's pretty interesting because look at what happened here. Look at the last earnings period, folks. Huge gap down, which I predicted. I got it wrong by $6.50. I said coming into earnings, I said Amazon is going, the numbers are still going to be good, but the outlook isn't. And I said my target is 3,300. It went down to 3306.50. I nailed it. I had buddies who said it was going to be a blowout earnings and they were wrong. Why? How did I nail it and they get it wrong? Because folks, let's do the 1 year chart here. This happened, right? Here's the scandemic shutting all of us down. Here's Amazon with everybody locked inside printing money. The math eventually was going to catch up to that. What do I mean by that? This, right? The market is forward looking. So this rip your face off rally was based on what? These earnings out here. I knew it was only a matter of time before Amazon said, yeah, we kind of reached our cruising altitude and we've leveled off. The numbers are still fantastic, but we're not printing money because everybody's still not locked up inside, ordering their Pelotons and Lululemon clothes. Does that make sense? So we knew this, but this is a massive buying opportunity in Amazon. Look at what it does. Here's the trend of Amazon. Let me go to this one. Rip your face off rally sideways. Rip your face off rally sideways. That is not going to happen, folks. That's going to happen. We are due for another leg up in Amazon, and now it is absolutely the time to get long-term bullish on Amazon. And let me pull up the options chain. Look how far out in time we can go on Amazon and be bullish. You can go all the way out to June of 23 to get bullish on Amazon. Okay, and that's how I'm going to teach you to do it on Monday afternoon at noon in our solo Amazon brief. We're going to fly all the way out here in our F-35 and get long-term bullish on Amazon, and then short-term either bearish or neutral. That's the beauty of trading options, folks, is you can be kind of bipolar. You can say I am long-term bullish on Amazon out into the future, but in the front months, it might be bullish, it might be bearish, it might be neutral. Remember, October, November-ish, what happens with Amazon? We usually see fill in the blank with me, Santa Claus rally, right? Every fall, I'm always long-term bullish on Amazon, but usually every fall, I add more Amazon. So next week, we're also going to take a look on some bullish spreads out to October and November on Amazon because we usually get that Santa Claus rally. So very, very happy with this. Munira, I hope I said that right. So he or she says Amazon is very expensive stock for trading. So what did I say a couple minutes ago? Not only in this service do we trade Amazon, we also trade what, folks? XLY. Because the XLY 25% of this ETF, let's just say round up, a quarter of this ETF is Amazon, folks. So this is a good substitute to trade. Okay, let's take a look at a 1-year chart of Amazon of XLY. Let me scroll out a little bit here. There's XLY. Let's compare Amazon. So Amazon clearly has outperformed the ETF, but the ETF is still a good, look at the movements, down, up. It's similar movements, but it's a lot cheaper. So very good point. Amazon is clearly more expensive, but that's why I briefed that we also trade the ETF known as XLY. Does that make sense? Okay. So folks, to keep Anna and the rest of the folks on time, let me give you a quick update because I know a couple of you asked how you can get on board, and I'm going to tell you right now. Solo Amazon is our newest live trading service here at Top Gun Options. Our live trade briefs, our other briefs, are usually $167 a month, but if you want to join us, I'll give you Solo Amazon today for $97 a month, or if you want to do an annual subscription today, I'll give you a 25% discount and make it $897 a year. If you want to do an annual, there's the link. I'll give you the link in a couple minutes to do the annual, and I'll also give you the link to do the monthly in a couple minutes here as well. But let me brief you on what you get. And this is a 50% discount from our other services here at Top Gun Options, folks. So if you're kind of interested in doing what we do here at TGO, come check us out with Solo Amazon. Last year, we absolutely had a blast, 6 figures in our Solo Amazon portfolio. Year to date, right now, we're looking at winning trades, 76% win rate, a total trades of about 30, winning trades about 38%, total trades of 50. Can attend Monday at noon. Well, folks, 80% of our members work Monday at noon, but guess what? I send out a time-sensitive text and email alert that looks like this. There's a screenshot of my cell phone when I sent out a text alert, and at the same time, an email alert fires with a screenshot of the trade, which leg I'm buying, which leg I'm selling, how much, what the max potential loss is, what the max potential profit. And guess what? 30 minutes or so after the brief, I post the replay. Why? Because it takes about 30 minutes for the recording to render and for me to post it. Okay, so replay's posted about 30 minutes after the brief. Today, you're also going to get access to my proprietary manuals, the materials, the primary, intermediate, and advanced workbook. Primary, intermediate, and advanced. They're regularly $197. If you went and bought them on my website today, it would be $197. So if you're sitting here doing political science math like me, wait a minute, Wiz, there's a $97 per month offer, and I get the workbooks. Yep, let me help you out with the math. You just essentially made $100 if you take this offer today. So here's what you're going to get: access to the Solo Amazon brief every Monday at noon Eastern, the text and email alerts, the 3 skill-based manuals, and also access to our members only ready room. That's our online forum where you can interact with me, your fellow members, and ask questions and stuff like that. Parmar made 200 grand in Amazon on 20 call contracts. Kevin, Amazon synthetic stock, late to enter, up 200%, paid 8 grand, now 24 grand. Diane up 70 grand with 1 contract. Scott, hey Wiz, up 20 grand in 2 September and 2 October Amazon calls this week. I have never been there. Patience, persistence. Thanks, TGO. Wiz, update on my Amazon synthetic call for 6/21 expiration from Solo Amazon. It's no longer up 100 grand on 1 contract. It's now up 127 on 1 contract. My. So if you want to test fly this service for a month, I'll give it to you for $97. But again, the annual is the better deal. So here you go. This is the annual membership for $897. Let me post that in the chat box there. Or Anna already did it for me because she is a good wing woman. And then let's go ahead and do the monthly. This is $97 a month. And yeah, you can upgrade. You can do this one right here. I just put that in the chat box. This is the monthly one for 97 bucks. And you can upgrade it anytime. Hey, Wiz, I tried it out for a couple months. Let me go ahead and upgrade into the annual. Absolutely, we can do that. What was that question right there? Tom, what kind of money account do you need? Tom, I don't give individual investment advice, but and I strongly recommend that you paper trade before you put any real capital at risk. But I think most brokerage firms, I think you have to open an account with $1,000 and maybe to trade on margin, it's $2,000. But remember, with options, I mean, let's take a look at the XLY here. Some of the options in the XLY, if they're cheap, right? If you wanted to, do a bull put spread out, a couple $1,000, Tom, is a roundabout answer. But $5, 10, 15, $20,000 with options give you leverage, right? Instead of buying the stock or the ETF, you can use options as a substitute. But I kind of hesitate to give you an exact number because I just don't know. I don't know your individual risk tolerance and objectives and stuff like that. That's why I always recommend people talk to a registered investment advisor before doing this stuff, because those folks will sit down with you. You'll probably have to buy them lunch, but they'll ask you your risk tolerance and all that type of stuff. But you can open a brokerage account for a couple $1,000 and trade it. Some of these call contracts are $2 out to September, right? Hey Wiz, I think XLY is gonna, let's just take a look at XLY real quick. Let's go out to December. You know what? I think the XLY is going to have a Santa Claus rally, Wiz. So maybe buy some upside calls on the XLY. Buying one December 21 185 call is $485, right? So not too expensive right there. 10 of them would be $4,900, and you can just scale up from there. So good question, but it's kind of a hard to give an exact answer. Okay, so there's the potential $97 a month offer, but I feel like the guy from Flex Seal, but wait, there's more. After you get your monthly or your annual membership, please, 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 I'm begging you, you got to do the full throttle trading. It's only $195. I'm going out and to dinner tonight in Fort Lauderdale. I guarantee it's going to be more than $195. Folks, this is 8 sessions. So if you're sitting here going, man, I have no idea what a long call diagonal is or synthetic stock, well, guess what? You're going to get access to training on a long call diagonal and synthetic stock. You're going to get access to training 8 sessions. I've seen places that charge thousands of dollars for this, and it's a disgrace. It's awful. I love doing this stuff, teaching. So if you don't know what an option is or calls or puts or anything, we take a building block approach here at Top Gun Options, man. We'll start with the basics and go all the way up to advanced tactics. That's how I learned to fly an airplane in the Navy, folks, was building block approach, okay? So Solo Amazon, as I said, it's our newest live trading service here at Top Gun Options. Our other briefs are normally $167. You can get this for $897 a year or $97 a month. Both those links are in the chat box. I strongly recommend you take a look at it. At least try it out for 30 days, man. Like I said, $97 is a nice bottle of wine, and you can't go wrong. Okay. Like I said, well, if you didn't learn anything from me today, then I've clearly failed. But do me a favor, take some time to go around your trading cockpit. Take an inventory today, kind of debrief yourself. Are you my doctor buddy with 33 positions? I'm telling you, man, I do this right now. I have 3 positions. I have Robinhood, XLY, and Amazon. And that's a lot for me to monitor, folks. If you got 5, 10, 15 positions and you're a retail trader and you don't do this full time, God bless you, man. You're doing really good. You're awesome. You are the exception, not the rule. Many of you, I know this from doing this for 31 years, folks, 3 decades of doing this. Many of you are flying around in that F4 Phantom. You got 300 switches and dials, and you're kind of task saturated, okay? So simplify your trading cockpit and check us out here at Top Gun Options. Again, before I go, as a former service member, I'm asking you as a fellow American to pick up the phone, or drive over to somebody's house if they served in Afghanistan, because this is just not good. My foundation, the Top Gun Fighter Foundation, we're doing our best to outreach and talk to veterans that are having a rough time because they served, they got wounded, or they lost a best friend. So do me a favor, just if you can, keep those women and men in your thoughts and prayers, because they need it. Okay.
Okay, great, perfect. Thank you all for joining us here today. I'm really looking forward to sharing with you guys one of our favorite strategies at NetPicks. It's what we call our overnight pop trade. I'm a big options trader. I've been trading options since 2002, and out of everything I've done over the years, this is hands down the strategy that I enjoy using the most. So what I'm going to do today is I'm going to share with you the exact tools that we use for the setup, how to book profits overnight using this one popular strategy, how to diversify with trades under $200 in many cases, and how to use credit spreads specifically to simplify your trading and trade in a safe way. These are fully risk-defined positions that it's very important in today's market, and we can see any news event occur at any point during the day or night, right? We've seen it here today. We had more news on the infrastructure bill and what's going to happen with taxes, and here we go. We've got big range in the market. So I personally feel more comfortable being in risk-defined trades. I'm going to walk you through how I do that over the next few minutes. I'll also show you my indicators that I use to find our setups each and every week, and then we'll walk you through how we select the best stocks and ETFs that you should be trading right now. So if you have any questions during the presentation today, feel free to type those in and I will get to those as soon as possible. Now, when we talk about options trading, there's really two styles of trading options. You've got your short-term directional trades. There's just buying outright calls and puts to benefit from short-term moves higher and lower. On the plus side, you've got big profit potential with limited risk. Who wouldn't like that? That's why we're all attracted to trading options. On the downside, these trades only have one way of making money. You need a directional move in your favor, and it has to happen quickly. It's the only way you're going to make money. And when we see moves like we've seen on AMC the last couple of days, look at this chart. This isn't even updated for the market here today, but we're seeing phenomenal movement on AMC. The tricky part about this and the trouble for retail traders is they look at this and they assume that this is the new norm. The meme stocks are going to be all the rage going forward. 100% moves like we saw yesterday are going to be a regular occurrence, when in reality, we're just in a historic move. You're in an historic environment right now. What you don't want to do is base your trading decisions long-term off the assumption that this is going to happen repeatedly. I'm not saying you shouldn't trade AMC. You just want to do so with very small position size. You don't want to chase results. What I'm going to do is show you how to trade names like Apple, Facebook, Tesla, the index ETFs. These are markets that have historic track records of making good movement back and forth. They're very liquid products. So you're not just chasing the hot name in the news that week. That's a very difficult ball game to play. Anybody looked at AMC options today? If you looked at the implied volatility in those options, you're looking at implied volatility numbers between 400 and 600%. What that means is that the market makers are pricing in that uncertainty. Those options are incredibly expensive. In order to make money, you need those huge moves. They need to be big enough to offset any type of volatility contraction that we get over the next few days. If the volatility contracts, you could see a $20 move in AMC, and if you're long an option, there's not going to be much profit to be made there. It's very difficult to take an AMC stock that doesn't show a track record of big moves. It's very difficult to trade it with options when the market makers are starting to price in that uncertainty. So instead, what we're going to talk about is style number 2, which is selling credit spreads. These trades they're going to produce a smaller profit potential, but in exchange, we're going to have 5 ways of making money on the trades. You're going to have a higher probability of success. You're going to be able to make money in many types of market conditions, and best of all for me, the credit spreads take less time to manage, which you'll see in just a moment. Now, in exchange for the higher probability of success, we do have the smaller profit potential. It still can add up to a big number over time, which you'll see in just a moment, but you have to be aware of that. This is not going to be the perfect strategy that you're going to throw everything into. It's just one tool in our toolbox. I want you to use both styles. I want you to use long calls, long puts, but I also want you to use credit spreads as well. That's where you're going to see the consistency over time. That's what's missing for a lot of retail traders. Now, when you hear the term credit spread, a lot of times people get intimidated by that. They think, hey, it's an advanced strategy. I don't understand it. It's riskier. It's actually not. It's actually the safest trade that you can use when trading options. It's a fully risk-defined trade. All it means is we're using a vertical spread. We're trading 2 options at the same time. We're buying one call or put, and we're also selling a separate call or put at the same time. It will keep us in a risk-defined trade. It helps lower the cost of the position, and it gives us a higher probability of success. There's a lot to like about the vertical spread. We can use them multiple different ways. I can either buy the spread, which is known as a debit spread. The issue there, it runs into the same issue as a long call, long put. You've got one way of making money. That stock better move in your favor, and it better do so quickly. Now, the spread can be safer than just buying an outright call or put because you are able to lower the cost of the position. The vertical spread is going to move slower in reaction to the changes in stock price. So it is a nice strategy, but it is totally reliant on that stock moving in your favor. The credit spreads, on the other hand, allow us to make money if the stock moves up, down, or sideways. We can also make money from time decay adding up and from volatility decreasing. So now I put 5 different ways of making money in my favor. We're still in a fully risk-defined trade, still a very safe position. It's a more forgiving trade. And in this market, with so many false moves in both directions that lately, I want to be in that more forgiving type trade. So the debit spreads are going to give you a lower probability of success, but a higher potential return. The credit spreads are going to give you a higher probability of success, but a lower potential return. Both are great trade types, right? There's no right or wrong answer. For us, we like to use both. It gives us that flexibility to react to different types of market conditions. Now, when we talk about the pricing model of an option, a lot of retail traders strictly focus on the stock price movement. Right? If you're bullish, buy a call. If you're bearish, buy a put. Stock moves in your favor, you're good to go, right? There are actually 6 different inputs that go into the pricing model of an option, and we need to be aware of each one. So you've got the stock price, strike price, time to expiration, volatility, interest rates, and dividends. All 6 of those go into the pricing model to give us the current price of the option. If we focus strictly on the stock price, we could potentially find it difficult to make money long term. The 2 other inputs that have a huge impact on the performance of a trade is going to be the volatility and the time to expiration. The volatility, which your broker platform is going to do, it does this for you, so you don't have to worry about doing all the math yourself, but it's nice to understand why they're coming up with the option price. They're going to do some simple math. 5 of those 6 inputs are known. They're fixed. You know what they are. The one wild card is volatility. What the platform is going to do is it's going to work backwards. If we know 5 of the inputs and we know what the current price of the option is, then we know what level of implied volatility is being used to give us the current price of the option. As volatility moves higher, the options become very expensive. As volatility moves lower, they become cheaper. So if we go back to AMC, the implied volatility being used to price the options right now over 600%. If that volatility starts to contract, which it will. It absolutely will over time. What that's going to cause to your option position, if you're long an option, it's going to cause those options to get cheaper. You want to know that up front. Even if you get a directional move to the downside, you're not guaranteed to make money with a long put if the volatility starts to normalize. We absolutely want to pay attention to volatility. Ideally, when volatility is high, I prefer to use more credit spreads. It just allows me to put more odds in my favor. Now, the time to expiration, the time decay, is also a big input that can influence the outcome of your trade. And here's a graph of the time decay. You know that every day you hold that option, it's going to lose value. If you go farther out in time, if you start to go out 50 days, you can see the time decay is still there. It's not as big of an impact. As you start to get closer to expiration, notice how that time decay really starts to pick up. It falls off a cliff. As you get closer to expiration, the options become cheaper, which a lot of retail traders like, but they're cheap for a reason. There's a lot that needs to go right in your favor. Those options are losing value very quickly every day that you hold the position. As long as the stock moves in your favor, you're fine. But if the stock just starts to chop sideways or if it moves against you, it's almost like a double whammy. You're going to get hit on the directional move, but you're also going to get hit by the time decay adding up as well. One way that we can take advantage of the time decay picking up, instead of buying an option, let's go ahead and sell a credit spread. So now during the last couple of days before expiration, that time decay dropping off a cliff, that helps us. We can make money from that type of movement. What we're going to talk about with the overnight pop trade is we're going to take advantage of the extreme time decay that kicks in the last 24 hours before expiration. The way that we structure our trades, we're looking to put the numbers and statistics in our favor. I'm not basing my decisions off of news. I'm not basing it off headlines, what the financial media sources are saying. I don't care. All I'm focused on is the numbers and price action on the chart. when we talk about the bell curve, which is what you're seeing here on the screen, the bell curve and standard deviation, they're terms that they're thrown around by a lot of traders, and a lot of times retail traders just don't understand what they're referencing. We're applying it to the trading world here. This could be applied to other areas of business, sports, but in the trading world, it can be very valuable. And all it's looking at, if you take a look at the price movement of a stock over time, the bell curve is essentially saying that 68.2% of all occurrences are going to fall inside of a defined range. And if you've traded for any length of time, you've probably seen that. Stocks stay range bound in a lot of cases. More often than not, they're staying inside of a defined range. But we also know that stocks will break out and we will see big moves to the upside and to the downside, and we'll get overbought and oversold extremes. If I start to go out one standard deviation, for example, on the upside, it's possible, just not probable. Only 13.6% of all occurrences are going to fall outside of that one standard deviation move. If I start to go out two standard deviations, only 2.1% of all occurrences fall outside of that range. And if I start to go out past three standard deviation moves, you're looking at 0.1% of all occurrences. The same goes on the downside. The takeaway here is when I start to notice stocks getting into these extremes on the upside or the downside, I am interested in putting on a position that would benefit from markets normalizing, from either a period of consolidation or a reversal in the other direction. Because if we start to get a stock that's moving at a two standard deviation type move, I know that only 2.1% of all occurrences fall outside of that range on the upside. And in order for markets to normalize, price is going to have to sell off because we know 68.2% of all occurrences are going to fall in this middle section. So in all likelihood, going forward, could be the next day, it could be a week or two later, in all likelihood, price action off of that overbought condition is going to start to gravitate back towards this middle section. The same goes on the downside. If I start to see an oversold condition, they will absolutely happen. They're going to happen throughout the year, especially on some of the big names like an Apple, Amazon, Tesla. They get to those overbought and oversold extremes. And those are the ones that are of interest to me. Because I know if I see a stock, if I see Amazon, for example, hit an oversold extreme, let's just say it hits a one standard deviation move. I know that only 13.6% of all occurrences fall outside of that range on the downside. In all likelihood, price is going to stabilize or even bounce to the upside because it has to get back to that middle section where 68.2% of all occurrences fall. Okay, so now how do I apply that on an actual chart? How can I apply it in real time? It's always easy to look back historically and say, hey, I would have done this and I would have done that. Is there a way in real time to identify those overbought and oversold extremes and give us an opportunity to benefit from them? We're going to start out by taking a look at a chart of SPY. This is the S&P 500 ETF, and this is a 130-minute chart. The indicator that we've programmed down at the bottom, it's that red, yellow, green, and blue histogram. It's what we call our pulse indicator. It helps identify visually whether we are at an overbought and oversold extreme. If I start to see yellow bars like we did right here, that indicates that price is between a 1 and a 2 standard deviation move on the upside. In other words, we're in this section right here, where 13.6% of all occurrences fall. Okay, so if I know that we've hit an overbought extreme, doesn't mean SPY can't move higher. It just means in the near term, it's not probable. Look what happened very quickly after those yellow bars started to plot. What happened to price? We consolidated it for a day or two, and then we reversed back to the downside. It's a very repeatable pattern. We then saw green, blue, and yellow bars on the downside, indicating an oversold condition. If I see the green bars, that indicates that price is between a 2 and a 3 standard deviation move. If I see a blue bar like we got here, that means that price is past a 3 standard deviation move. When I start to see green and blue bars here, now all of a sudden, we're in this section here, where less than 2% of all occurrences fall. It doesn't mean that SPY has to immediately reverse back to the upside. It just means the odds of a continued big move lower, they're not probable. Okay, so what we did, let's go back to the yellow overbought condition on the upside. We like to take advantage. There's a number of different ways that we can take trades based off of this pattern, but what we like to do is use an overnight approach. This is a trade that we like to put on the day before options expiration, and we look to close the trades out the morning of expiration day. It's not a day trade. We are holding overnight, and SPY QQQ, those are the two index products that we trade. SPY being the S&P 500 ETF, QQQ being the NASDAQ ETF. They both have 3 expiration cycles every week. They have options that expire every Monday, Wednesday, and Friday. It gives us 3 opportunities each week for a potential overnight trade. All other stocks that have weekly options will give you the opportunity for this overnight trade Thursday afternoon into Friday for Friday's expiration. On SPY, because we were overbought here, we came in and we sold the 423, 425 call spread. All that means is I'm selling the 423 call and I'm buying the 425 call at the same time. We collected $65 per spread. It only tied up $135 of my capital. That's the most I can lose on the trade. That's my max risk. If you've got a bigger account size, absolutely you can take this trade with multiple spreads. You can bump up your position size. You're talking about $135 of capital per spread. So very reasonable number regardless of account size. The goal on this trade is I just want a price to stay below 423. That is the strike price of the option that I sold. I don't care if the stock moved up, down, or sideways. Didn't matter. As long as it stayed below 423, I was okay. Even if it only did so by a penny, we're going to make money. We also make money from the time decay adding up. We know that this close to expiration, the time decay is extreme. And then we also make money from volatility decreasing. So we've got 5 different routes to follow on the trade to make money. Fortunately for us, we did get a move to the downside the very next morning. We closed out of the position for 19 cents. It gave me a $46 profit per spread. That's a 34% return on my capital overnight. $46 of profit, not all that impressive, right, at initial glance. But remember, I only tied up $135 of capital to begin with. If you put on this position with $500 of risk, now all of a sudden you've got $138 of profit overnight. Remember, we're looking for multiple trades each week using this strategy. It can add up in a big way. You put it on 10 times with 10 spreads. Now you've got just under $1,400 of risk. Now you've got $460 of profit overnight. You start small, you build that account, you keep that risk at a manageable level, and over time, you're going to grow this to where it can be a great supplemental income, potentially even replace an income. We had 5 ways of making money on the trade, so it was a very forgiving position. Now looking at QQQ. Okay, very similar trade. We came in, we sold the 328, 330 call spread, collected $62 per spread, risked $138 of capital per spread. So the key to remember there is the only way I take the full loss on the position is if I hold all the way up to expiration. We don't typically do that. In fact, it's very rare that we would do that. We can always close out of the trade early and either take the partial profit or the partial loss. That allows us to control the risk. The goal on this trade, because we sold the 328 call, I want a price to stay below 328. I didn't need a big move lower. I just need a price to stay below that 328 strike. As long as it did up, down, or sideways, we were okay. We're going to make money. We also make money from volatility decreasing and from that extreme time decay that's there right before expiration. We came in the next morning. Within the first 30 minutes of the session, we're closing out of the position for 6 cents. Gave me a $56 profit per spread, 41% return on my capital overnight. We look to place these trades around 3:30 p.m. Eastern time, 30 minutes before the market closes. And in many cases, we're going to be able to close out of these positions in the first 60 to 90 minutes of the session the following morning. The nice part about that is it gives me predictability. I know when the setups are going to be there. I know when to look for them. It's always going to be that last 30 minutes before the close, the day before expiration date, and then we close them out the following morning. I don't have to sit there 8 hours a day looking at charts, waiting for the market to move. I know exactly when to put the position. So if you're using $500 of risk per trade, you're talking about $168 profit. Remember, you start to take multiple trades each week. Between 2 and 4 trades each week is very typical for us. This can add up to a really nice return going forward. We also like to use the individual stocks. We absolutely need to make sure that we're looking at liquid markets, very important. So you're not just going to come in and run a stock scan and pull up a random stock that's overbought or oversold, because we have to make sure it has liquid options. These are time-sensitive trades, meaning when I'm looking to close out of the position on expiration day, I want to be able to come in and close the position out very quickly. If the stock isn't liquid, if it doesn't have liquid options, it's going to be more difficult to get filled on that order quickly. That's why I'm showing you SPY, QQQ, Tesla. We'll take a look at Apple. Very important to go to the most active products. I love Tesla because it's a $500-600 stock. I love it because if you look at the long calls and long puts, you're talking about potentially thousands of dollars per contract. with the credit spread, we were able to put this position on for $350. Here's how we did it. The market got oversold. Okay, how do I know that? The pulse indicator down at the bottom is plotting yellow. Again, that's indicating that it's between a 1 and a 2 standard deviation move on the downside. We're in this section right here. Only 13.6% of all occurrences fall outside of that range on the downside. I know going forward, whether it be the next day, the next week, over time, price is going to want to gravitate back towards this middle section because 68.2% of all occurrences fall there. So what we did, it wasn't immediate, but look at how quickly price on Tesla, once it started to plot yellow on the pulse, look how quickly price started to settle into a range. Eventually, we did get a bounce to the upside, but once we put the trade on, had we come in and bought a long call just expecting Tesla to bounce, it would have been a very difficult trade. But because we used the right strategy, we were able to make money from the stock moving straight sideways. This is a type of pattern that gets most people into trouble because you're trying to force trades expecting those big home run moves, when in reality, the market's not always going to give us those big once a month, once a year moves. And we're just not going to see the AMC type moves on a regular basis. Instead of forcing the long calls to work here, we came in and we sold the 565, 560 put spread. I'm selling the 565 put, buying the 560 put at the same time. We collected $147 per spread. It tied up $353 of my capital. That was my maximum loss in the trade if everything went against me. If that extreme oversold condition got even more oversold, the most I was going to lose was $353. I love that because it allows me to control the risk on an expensive stock. It also gives me 5 ways of making money on the position. All I needed was for Tesla to stay above 565. If it moved to the upside in a big way, if we just chopped sideways, even if we drifted slightly lower, I was okay as long as price stayed above 565. I was going to make money on the position. We also made money from the time decay adding up and from volatility decreasing. So again, those are the 5 ways that we have of making money on the position. The very next day, mid-morning, we were able to close out of the position, book a $55 profit. That's a 16% return on our capital overnight. And I love that. It doesn't look like a big percentage return, but a 16% return when we really never got a big directional move. It's a very forgiving trade. That's why I love this strategy. That's why it's one of my favorite strategies. If we get a big directional move, perfect. We'll book the larger percentage return. If we don't get the big move, if we just chop sideways, we're still able to navigate through that and generate a return when the market is just not ready to move. What about Apple? Probably the most liquid stock over time. You have AMC that's just dominating the volume headlines the last week or so, but in most cases, Apple is near the top of the list as far as liquid products. Notice how the chart looks very similar, right? We're still using the pulse indicator down at the bottom. I'm still using the 130-minute time frame. The pulse indicator got overbought. Now notice here that it stayed overbought for a couple of weeks. But we did not get the immediate reversal to the downside, but look up top. Once those yellow bars started to plot on the pulse, see how price started to settle into a sideways range? We eventually got the pullback. It did not happen immediately. That's why I don't just come in and buy a long put here expecting Apple to sell off. Instead, I'm going to come in and sell a call spread. That way, if we do settle into a sideways range like we did here, I'm still able to generate some income from that move. What we did is sold the 134, 136 call spread, collected $60 per spread. It tied up $140 of capital per spread. It was a neutral to bearish position. I was going to make money as long as the stock stayed below 134. Counter sideways didn't matter to me. The time decay was extreme. That helps me. And we also make money from that volatility decreasing if it does. Fortunately for us, we did get a move to the downside the next morning. We were able to close the position out for 12 cents. Give me a $48 profit per spread, 34% return on capital. Overnight, $144 of profit if you're risking $500 per trade. We can do some simple math here. Apple's so liquid that if you were to put this on 10 times, you're not going to have any difficulty getting filled on that order. You're going to have $1,400 of capital at risk. And now taking this trade with $1,400 of risk, you got a $480 profit overnight. Is that attractive to anybody? That's what I love to do on a regular basis. I'm absolutely going to take long calls and long puts with part of my portfolio, but if the market's not always moving, this strategy right here can fill in the gaps. This is what can create a smoother equity curve, and that's what we're all looking for. It's always fun when we have those big directional moves. When you have a long call and the stock zooms to the upside, it's fun to book those profits. They just don't happen consistently enough. That's why we're going to keep that as only a part of our toolbox, and we're going to add in the credit spreads to fill in the gap. Now, what about long-term performance? Okay, what does it look like if you take a look at all of the trades that we've taken here with this overnight pop trade service? It's not fair to just look at the winners and ignore the losers, because the losers are going to happen. As much as we love to stack the deck in our favor and put the odds and numbers in our favor, it's not 100%. We're going to have losses along the way. It's all about making sure that those statistics are in our favor over time. So over the last almost 110 trades that we've taken with the service, we have a 78% win rate. We're winning nearly 8 times out of 10. If you just look at the trades that we've taken so far this year since January 1st, we've got an 83% win rate. So the losses are going to happen, but we know that we're going to have a much better winning percentage over time with the credit spreads rather than just buying the outright calls or puts. The profit, if we take a look, you're talking about $3,000 of profit just using very small position sizes. If you ramp it up a bit, let's just talk about risking $2,500 per trade. Maybe you're not at that point right away. That's fine. We can start out small. We can grow the account size over time. But just risking $2,500 per trade, now you've got $15,000 of profit on trades that are in and out in less than 24 hours. So you're looking for these trades a couple days a week. On average, the average cost per trade is $154. We can do some simple math there. If you take each trade with 10 spreads, for example, you still only have $1,500 of risk. This is a great way to keep the risk small, generate that source of income each and every week. And everything that I've showed you, whether it be the spreadsheet here or the trade examples that I just walked you through, these are all trades that we have taken with our customers. These are all trades that we have sent out in real time. Alert our customers when we're opening a position. We also alert our customers when we're closing out of a position. Let me go ahead and jump back in and we'll walk you through some additional details. So the trades that I just showed you, here's the exact criteria for setting up those credit spreads. We're looking for these trades on the options that have 1 day left to expiration. The strategy works best on liquid markets, so we want to make sure we're trading the well-known names that have liquid stock and options. We want to select the spread where we can collect between 30 and 40% of the width of the spread. I want to try to be in that risk 2 or 3 to make 1 ring. So if we're trading a dollar wide spread, I want to collect between 30 and 40 cents. That allows me to control my risk reward ratio. Once in a trade, we're going to look to exit when we can keep between 50 and 75% of the potential gain. If I collect 60 cents to put the spread on, I'm going to look to buy it back for between 15 and 30 cents. That would allow me to keep between 50 and 75% of the potential gain. And we're looking to do that within the first 30 minutes of expiration day. This is the criteria, whether we're looking at QQQ, Tesla, Apple, this is the criteria that you can use on every trade. That's a very simple process. So along with the results that I just showed you, here's some additional recent results. On the overnight pop trade, we just continue to see very consistent returns. That's why we love the strategy. I mentioned on the spreadsheet, we're winning nearly 8 out of every 10 trades. That's not just over the past 10 trades, right? And we're not just looking at recent results saying, hey, the market's been active, we've had really good returns. These are numbers going back over the past 100 plus trades. It's very consistent and the numbers are going to continue to work out in our favor because we're using the credit spread. It definitely stacks the deck in our favor. So the simple formula is this. We send out between 2 and 4 trades every week, right? SPY and QQQ have Monday, Wednesday, and Friday expiration. So we have 3 opportunities there. And then names like Apple and Tesla, Facebook, Amazon, we'll be looking at those Thursday afternoon for Friday. Place the trade in the afternoon, book the profits, close out of the position the following morning. That's the formula that we're following each and every week. If you're somebody with a busy schedule, the nice part about this approach is when the alerts are going to come out. They're going to come out at 3:30 p.m. Eastern the day before expiration. We're going to close them out the following morning. This is not going to require a huge time commitment to take and manage the positions. The trades that I talked about here today, the highest cost on any of those trades was Tesla, and it was a $350 cost. In most cases, our trades are going to be around the $150 to $200 range. The average cost of all the trades that we've taken since the service was released is $153. So it's a very reasonable approach regardless of your account size. It just allows you to trade those high flyers for a fraction of the cost. And you can trade right from your smartphone, which I'll show in just a second. So the overnight pop trades, it's a recommendation service where we send you those trades each and every week. You can piggyback off of our trades. We're going to be sending out trades yet this afternoon for Friday expiration. So we'd love to jump on board and join us for our next round of setups here this afternoon. It's going to give you around 150 actionable trades each year. So you're going to stay very active without this turning into a full-time job. These are trades that you can actually take, copy right into your own account and track along with us each and every week. These are some of the common names, some of the popular names that we trade: Apple, Microsoft, Tesla, Google, Facebook, the index ETFs. The liquid products allow us to trade with more confidence. It allows us to get better fill prices, which will improve our bottom line over time. And all these names, again, you're talking about a few $100s of capital. Nothing is complicated. Everything is done for you. Detailed trade alerts are sent out each week. We can send them out through email. We also send them out in our NetPicks app. If you're on the go, you can put the app on your mobile device. Once the alert comes through, you're going to see it pop up on your phone, just like a text message would. It's just a notification. You click on it, it takes you into the app, and it'll show you the exact details of the trade that we're taking, the options that we're trading, the price range that we're looking to get filled at, how much time is left to expiration. All of that information is right there in the alert in real time. You can then take that information, put the alert on, whether you're by your computer or you can just use your same mobile device and log into your broker platform and take that trade, get the order working in literally 60 seconds or less. It just gives you that flexibility to stay active even when you're on the go. And with the economy starting to open back up, people are starting to go back to work, right? At some point in the coming months, and we're going to see people back in the office, right? People aren't going to be able to be at home in front of the computer looking at markets all day. This is a way that you can stay active, place, manage your trades right from your device. We not only send you the alerts when we open the positions, anytime that we're managing the trade, we'll send you those alerts in real time as well. You'll also have access to our owner's website. That's where we have all of the setup instructions, all of the training, the support, all of that will be available from day one. This is a signal service, so we send out those trade alerts each week, but we also know that some people want to take their trading to the next level. They want to understand more about how the credit spreads work. We have training on the owner site that'll walk you through how the credit spreads function, how we make money from them. That way, if you do want to take control of your trading and start to find trades on your own, you're going to have all of that training and criteria that you need to find those setups on your own. You'll also have access to our complete support team. We are working with traders all day, every day. We've got a team of coaches here that can help out with any type of issue that might pop up. If you need help placing a trade, if you have a question, want us to review a setup before you pull the trigger on a trade, you just let us know. We're available for phone and email support. That is all included with the program. So here's what it looks like. The regular price of the program is $12.97 for the annual plan. I'm not going to charge you anywhere close to that here today. We've got some very special offer that we're going to talk about here in the next few minutes. So everything you need, the trade alerts, the owner's website, the training and assistance from our coaching team, all of that is included, but we're going to go ahead and take $5 off the price just for joining us today. I know you've got things going. I know you've got many different offers hitting your email inbox every day. So we're going to try to sweeten it as much as we can to show you that we are committed to making sure you are successful with your trading. So we're going to take $500 off. That brings the annual price down to $797. As you can see from the results, a couple of winning trades, and you're talking about paying for the service. The rest of the year is just capital and profits that you can continue to grow your account with. We also have an unlimited plan available. $12.97 is the plan for the unlimited program. Same trade alerts, nothing changes there. It's the only difference is just in the duration of the membership. Some people just don't want to have to worry about an additional payment or recurring payment going forward. If you want the unlimited plan, we do have that available for $12.97. The third and final plan that we have is the 6-month plan for $4.97. If you're saying, hey, Mike, I'd like to keep that cost as low as possible, see if I can grow this thing from profits, we can certainly get you started on the 6-month plan for $4.97. I'm going to sweeten it one additional time here. So if you use the promo code EXPOS, EXPOS, it's going to take another 10% off the cost of each of those 3 plans. So it's going to take $130 off the unlimited plan, another $80 off the annual plan, or $50 off the 6-month plan. So when I share the sign-up link in just a moment, just make sure you use the promo code EXPOS in that promo code box, and we'll get you the discounted price. So it brings it down to $447 for the 6-month plan, $717 for the annual plan, and then the unlimited plan is down to $1167. So we're trying to keep that price as low as we possibly can for you, so you have most of your capital reserved for your trading. So here's the link to get started. It's netpicks.com/overnight. just go ahead and go to that link. Once you're at that link, make sure you type in Expos in the promo code box. That will get you the discounted price. We are including our bonuses, our quick start bonuses. If you are brand new to trading, we do have a complete training course that'll walk you through how to select the best broker, how to place trades in that broker platform, how the credit spreads work. All of that is included. That's a $297 value. We're going to include it with your purchase today, just to make sure you have all the tools that you need to get started. And then we also have the one-on-one coaching call that we're including. Eric is my right-hand man on the option side. He handles a lot of the support for us at NetPicks. You're going to be able to connect with us for a one-on-one call, and we can discuss any topic that you're struggling with. If you want help placing a trade, you want to just connect, walk through some risk management, how to set up your account, we can certainly do that. That's a $277 value that we're going to include with the purchase today. We do also have our money-back performance-based guarantee. Again, we know you've got a lot of offers hitting you on a regular basis, so we are confident that the system is going to work. We've seen it work in our own trading now for years, over hundreds of trades. What we're including is at the end of 60 days, if you have not seen your investment in the program return through profits, so the cost of the program, if it's not returned through profits at the end of 60 days, we would issue a full refund. We don't expect you to pay us if you're not making enough money to cover the cost of the program. Okay, we know the results are going to be there. The numbers are going to be in our favor over time. All you need to do is come in and take the trades when we send them out. We'll do the research for you. We'll do the hard lifting. You just go ahead and follow the alerts when we send them out each week. Here's some feedback from our customers. What I love about the feedback is not only are people loving the results, but the support. We pride ourselves on providing some of the best support in the industry. We are working with customers all day, every day, making sure you are successful with your trading. So you're gonna have direct access to myself. I'm working on the support side every day as well. I'm not just a sales guy. I'm not just a trader. I'm working with you in the trenches each and every day with the trade alerts. So here's, again, the link to sign up, netpicks.com/overnight, and just make sure you put in Expos in the promo code box and we'll get you that discounted price. So let me go ahead and take a look at some questions here. Charles, don't see where to enter the promo code. So Charles, when you go to the sign up link, when you go to the sign up page, you're going to select whether you want the lifetime, annual, or the 6-month plan. That's going to take you to the page where you're going to put in your information. And then down towards the bottom, you're going to see a promo code box down where you're going to put in your payment info. There's a promo code box there. If you have any difficulty finding that, let me know. I'll go ahead and get my contact info in. And my email is just mike@netpicks.com. Feel free to reach out. I'm more than willing to hold the spot for you, get you the special pricing, and we'll get that order processed for you today. Again, we're going to be taking trades this afternoon for Friday expiration. I love Thursday afternoon because we have the ability to trade Apple, Facebook, Amazon. We're going to be looking to get a position on here this afternoon right on 3:30 Eastern time. So we'd love to have you join us for those setups this afternoon. Okay, perfect. Thanks for the update, Charles. Glad you could find it there. As far as account size that's required to take the positions, we recommend starting out with $3,500 at a minimum. While you can start with less than that, a lot of our trades, we're talking about a couple $100 of risk. The problem with starting out with less than $3,500, it becomes very difficult to control the risk. Let's just say you start out with a $1,000 account. Okay, let's just say you start out, you have bad luck, you have a couple of losses within the first handful of trades. Thankfully, it doesn't happen all that often, but it's possible. The numbers are going to work out in our favor. We're winning close to 80% of the time. So I know that even if we have those 2 losses out of the 10 trades, if they happen right up front, it's not going to wipe out an account. We're going to continue to take those trades, and over time, you're going to be able to take advantage of those numbers and the odds that are in our favor. I've seen way too many retail traders lately. They get started and they take that approach. Hey, if I can just hit it big one time, it changes the ball game for me. That might be true. But on the flip side, if you take that big loss, it's so difficult to battle back, and you're left establishing a whole list of bad habits. We don't want that. We want to keep that risk small. We want to focus on building that account size over time. You will need to have access to a margin account. Even though we don't trade on margin, it is required if you're going to use the vertical spreads. The most popular broker that our traders use is Tastyworks. They have a phenomenal platform, very low commission rates. They charge a flat $1 per contract commission, but they only charge to get into a trade. They don't charge a closing commission. So you're going to save some long-term. Actually, you're going to save a lot long-term because they also cap their commissions at $10 per trade or $10 per leg on a spread. Let's say you've got a bigger account size and you start to take those spreads with 50 contracts or 50 spreads. You're never going to pay more than $20 on that trade. You're going to pay $10 per leg on a spread. That's a huge savings long-term when you start to build that account size. You can absolutely use the broker of your choice. We're not compensated to send people to Tastyworks. We just love their platform. So if you have another brokerage account set up, just make sure they're letting you use the vertical spreads, and that's all you need to get started. Are we guaranteed to take trades every Monday, Wednesday, and Friday? So no, we're going to be looking for 2 to 4 trades each week, just depending on market conditions. I'm never going to force a trade. There may be a situation where if I just don't see anything jumping out at me, I'm not going to force a trade just for the sake of being active. We are very committed to finding the best setups each week. So there could be weeks where we only take 2 trades. We've had weeks where we're taking 4 or 5 trades. It just depends on how active the market is. And the best part about that too is you're not going to be sitting there Monday through Friday all day long waiting for alerts. We send you those alerts when we're taking action on our side, and it's always going to come. Those alerts are going to be coming out during the last 30 minutes of the session. So between 3:30 and 4 p.m. Eastern, the day before expiration. All right, so again, netpicks.com/overnight is the sign up link. Promo code is EXPOS. So we'd love to have you join us. If you have any last minute questions, go ahead and get those in now. Otherwise, I am just about out of time here, so I'm going to wrap my portion up. Enjoy your afternoon, everybody. If you have any questions, feel free to reach out. Mike@netpicks.com is the email address. So at this point, Anna, I'll pass it back on over to you. Thank you for allowing me to speak here today.
Thank you so much, Michael. If you have a time, can you take the last question from Jana?
Yeah, sure thing. Let me go back up to the slide for the unlimited plan. So the unlimited plan is $11.67. It still gives you access to the same trade alerts as the other 2 plans. The only difference there is you're never going to have an additional payment going forward. There's no recurring monthly, quarterly, annual plans. It's just a one-time payment, and you have access to all the alerts going forward for the life of the program. So there's no additional charges past that one-time payment. So it's the best offer because you're never gonna have to pay an additional payment. If you need more details on that, send me an email, Mike@netpicks.com.
Good afternoon, everybody. Thanks for showing up to today's presentation. You know, it's always a pleasure. I love doing these presentations with Investors Expo because I get to hear other people's approach to the market. You know, there's so many different ways that a trader can approach the market. You know, and it's unlike any other business out there, right? You know, there's a lot of, I hate to say a lot of money on the table out there, but there really is. You know, it's a great market to trade right now. It's a great environment, and I'm going to talk about how I approach the market using order flow to develop a skill and become a consistent trader, which is really what you know, people always talk about. You know, there's no holy grail in trading. Actually, the holy grail is becoming consistent, right? You have to have an approach to the market that even, you know, if you have a few losing trades, as long as you stick to the plan, stick to what works, the money will come back, right? Everything will continue to work as per normal. So what you're going to learn today is why you should focus on trading order flow, what really matters in the order flow, and how to use order flow to become a better trader, right? That's all what we want to do, right? We want to become the best at you know, anything that we do, especially trading. And I'm going to be pretty quick and to the point and try to keep it within the 45 minutes. So just a little bit about me. I want people to understand my background and why I do what I do. I started on the CME floor in the 1990s with Dean Witter Reynolds. I was a runner, and eventually, I worked my way up. I left the trading floor. I became a Globex trader. I traded electronics when electronics started up. After that, I joined EDF Man, the big English trading firm. After that, Commerzbank, the big German bank. I traded Bunds, Babels, Schatz. I was one of a handful of traders that had an actual Eurex license in the United States. After that, I joined Cargill as a trading desk manager. They sent me out to Singapore to set up a trading desk when the exchange was closing down the floor, and it was going to be electronic exclusively. After 4 years there, I liked Singapore. I was offered a job with JP Morgan in Singapore on their trading desk. I was vice president of futures trading, and I spent 8 years there till I retired from, the sort of the corporate world. Honestly, I got tired of coming in at 5:45 in the morning and staying until 5, 6 o'clock at night. It just didn't give me any work-life balance. And I know that trading, if you're good at it and you know how to trade, it's something you could do on your own terms, right? You basically could be your own boss. It's a very entrepreneurial environment, being a trader. And around 2015, I started Orderflows.com. It sort of came about as I started writing a book on order flow. And eventually I developed a software that runs on NinjaTrader 8 to help traders understand what's happening in the order flow. And originally I created this software to help my own trading, right? Because as I'm trading for myself, I realized I need to sort of expand my vision rather than looking at 1 or 2 markets. I wanted to look at more, and I want to analyze more, and a computer obviously is going to help you do that. So I sat down with a programmer and said, hey, you know what? This is what I look at in the order flow. Can you put this into software? And we started doing it. And then other traders were seeing my software and saying, Mike, that's great. Can I get a copy? And originally, it was just for myself, but then, eventually the demand was so great, we started up orderflows.com. And the reason I talk about that is because the software generates the charts that you're seeing in this presentation. Now, like I said, after leaving JP Morgan, I just wanted to spend more time with my family. But then, I started realizing, I have a lot of information, right? And the thing with information, right, that you gain, over years of experience is, what good is it if you're not willing to share it with, other people, right? I have this philosophy, each one teach one, pass that information along, because, what good is it if you're just hoarding it? That's why I started writing this book. And if you stick around to the end, I'm going to show you how you can get it for free. And, just a brief disclaimer, I do want you to understand trading involves risk, right? Only risk capital should be used for trading, and don't trade your rent money, basically. So first thing I'll talk about is, why you should focus on trading order flow. And, a lot of people have this misconception of order flow. And, hopefully I could put that to rest tonight. But really, with looking at order flow, it really like putting eyeglasses on for the first time when everything is blurry. And all of a sudden you can see, the trees, you can see the words written in the book. And really that's what order flow allows a lot of traders to do, is see what's really happening in the market. So like I was talking about briefly at the beginning, what is consistency, right? Consistency in trading is not about being right 100% of the time, right? No one is. Consistency is about being able to come back from the losing trades when you experience a losing trade and not being wiped out. So, what that means is, you have a way of market understanding, right? And, you don't leverage yourself up so that one loss is going to wipe you out. You know that, yeah, no matter what system or method or way of analyzing the market, it doesn't matter if you have some super secret way of finding a buy level or sell level that nobody else knows, because if nobody else is going to be buying it after you're buying it, well, the market's not going to go up, right? But if you're reading the order flow, right, you're understanding, this is why the market isn't going up right now, because you see that same information coming into the market time and time again. Now, understanding the market is what keeps you safe, right? People get into all sorts of trouble trading, blowing up accounts, everything, because they don't understand what's happening in the market, right? They think they do, right? They're looking at a price chart and they think, well, yeah, see, it went up, price went up, right? So it must be going up. Well, they don't really understand that, maybe the momentum is getting weaker, or maybe on this move up, it's sort of pausing, but now it's starting to pick up again, and it's going to put in another new high. So, things like that, that's what order flow is going to help you become. It's going to help you become in sync with what's happening in the market, right? Because basically order flow is the market, right? It's not based on some mathematical formula. It's based on what's actually being traded in the market, what's trading on the bid, what's trading on the offer, right? It's not based on trend lines or any other lines you're going to draw on your chart, right? Because lots of times, you can just pick a high and a low and draw, any sort of line. Honestly, you could open up a chart and just draw random lines, and you can see the markets react to them, right? And there's no rhyme or reason to it sometimes. Order flow is not based on fib numbers or wave counts, nothing like that. It's based on what is being traded by the people trading the market. All right, what their perceptions of supply and demand is. It's not based on, outside, just I'll say outside factors, but things that have unrelated to the market, right? So we're all familiar with the normal candlestick or bar chart, okay? And honestly, when I first started trading back in the early 90s, this is when candlesticks were just becoming popular, right? And everyone wanted to be a candlestick trader, right? And there's these books, Steve Neeson, Gary Wagner putting out books on candlesticks, right? So that's what most people gravitate towards. But all they really show you is just the open, the high, the low, and the close, right? And where we closed in relation to where we opened, which is good. I mean, that's good information. I mean, you need that information, but you're really leaving out a lot of other information, like how much traded at a high, or how much traded on a low, or where the most volume was in the bar, or is this a pullback, or are we going to start selling off, things like that. And that's what the order flow helps you to see. So if you've ever stopped, right, to think about what's happened, what's causing a bar to form, it's going to really change your perception of the market. But all that information is derived basically from the time and sales, right? Every transaction that happens is recorded, right? The market trades in a two-way auction, right? The trading that happens between the aggressive buyers and the passive sellers, as well as the trading between the aggressive sellers and the passive buyers, all right? So basically you have four types of market participants. You have aggressive buyers, aggressive sellers, passive buyers, passive sellers, right? And once you understand that, then you can understand how the market is trading, right? But the problem is time and sales moves too fast to get anything meaningful from it, right? If you're trading in the evening session, 9, 10 o'clock at night in the US times, it's very slow. Yeah, you can look at time and sales. If you're looking at it during the daytime, forget about it. It's just moving too fast. But basically what happens is aggressive sellers sell to passive buyers, right? People that are working a bid, someone comes in and sells it to them, right? That's an aggressive seller, and that will register on the time and sales. An aggressive buyer buys from the passive sellers, right? Someone is working an offer up there, and aggressive buyer goes in and buys it. So that's how the two-way auction works, right? It's not just a bid and an offer. Someone has to be aggressive. Someone has to cross the bid offer line. Now, some traders like to look at a dome, right? And they say, well, dome is really order flow. Well, it's orders going into the market, but not necessarily trading. So again, passive buyers, right, are people that sit on a bid, right in here. These are the passive buyers. Passive sellers are the ones that sit on the offer. Now, an aggressive seller is somebody that moves their offer down and hits the bid, right? An aggressive buyer is someone that becomes, says, oh my God, I got to get into this trade. And they go ahead and they lift the offer. That's being aggressive, and don't let those terms, aggressive buyer, aggressive seller, put you off or confuse you. A lot of our everyday life, we are aggressive buyers and aggressive sellers, and sometimes even passive buyers and passive sellers. For example, right, in the US, it's a housing market. It's going crazy. The sellers are passive, right? They know they could just list their house at a price, and there's probably going to be an aggressive buyer coming in and buy it, especially if they price it low. Someone's going to come in really fast and buy it. And during the financial crisis, in 2009, when all the houses were on the market, buyers were passive. People could say, a $500,000 house where the person that's trying to sell it is underwater. A buyer could come in, yeah, I'll bid 400,000. Okay, now the seller at 500,000, he's got to get out of it, right? So he's going to become aggressive and hit that bid at 400,000. So, we all deal with passive and aggressive buying almost on a daily basis in our lives. Sometimes we just don't realize it, right? But we all face it. But the dome also has its limitations. It also moves too fast, right? Now, there's a lot of people that swear by dome trading. I looked at a dome my entire career ever since they first started having domes on the Globex system. And there is useful information on there, but now, honestly, it also moves very fast, right? Especially if you're on a market like NASDAQ or Dow or DAX or anything like that. Forget about it. The market's jumped up, price is not even on your screen anymore. You got to recenter it. But again, it's all about the aggressive buyers and the aggressive sellers, what they are doing in the market. Now, while you can see that, again, it's too messy. Order flow is great when the markets are quiet and slow, but when it's moving, you need something, a way to use that information and benefit from it, right? I mean, what good is having the information right in front of you, but not being able to access it, right? And there's a chart out there. It's called a footprint chart. This is the Orderflows Trader footprint chart that shows you not just the candle, the open, high, low, close, but it's also showing you the volume traded on the bid, the volume traded at an offer at a particular price. It's also showing you if there was an imbalance at a price. So if you have aggressive selling in the two-way auction, or if you have aggressive buying in the two-way auction, and that will show up as blue number in the volume, it's aggressive buying. A red number will show up as aggressive selling, right? So there's just so much information. There's delta, which is the difference between aggressive buyers and aggressive sellers. There's point of control, which is the point in the bar with the most volume. And all these little data points of order flow really help you understand what's going on in the market. Because, again, remember, what you're seeing happen, on your chart is what's actually trading in the market, right? Again, it's not mathematical formulas, that you don't understand, right? If a lot of people use indicators, they don't even know how they're formed, right? What goes into it, right? You got ADX. I had a buddy of mine years ago. He was, oh, this is my DMI ADX crossover, right? Like it's some secret system. Okay, well, that's interesting. Well, what's a DMI? Oh, I don't know. It's just an indicator I pulled up on the chart, right? He doesn't know the calculations going into it. But when you understand order flow, you're understanding why people are buying, or rather where people are buying and their intensity, that they're buying or that they're selling. But it's actually what's actually traded in the market, right? And that's important information. That's what you want to know. So order flow, right? What matters in it, right? Because again, you look at an order flow chart and you see a lot of numbers, right? People get scared of numbers. And I'm here to tell you, don't be scared, because you're not going to be analyzing every single tick. Like if you're analyzing a dome, you're analyzing almost every single trade that goes through, right? And you know what? I wasn't born in the matrix. I don't have a chip in my head. I can't do that, okay? I need a simple way to analyze the volume that's being traded at price. And that's what a footprint chart helps me do, right? Now, most people will say, well, I just follow price action because price is the best indicator. Well, it is, but it's limited, right? You got to realize price is just one piece of the trading puzzle, right? It's like in music, right? It's just one note, right? You can't make nice sounds with just one note, right? You got to put it together, right? You put different notes together to make good music, right? Something that's enjoyable. And analyzing the market is sort of the same way. You don't just rely on price alone. You could add in volume, trade on the bid, volume trade on the offer, obviously delta, imbalances, volume in a bar. There's a lot of information that you can take away and focus on. And I'm not saying you got to focus on every single detail. Stick to the basics. The three main points of order flow is delta, point of control, and imbalance. Right? I don't need to analyze, well, it's only traded 31 on the bid here against 150. Well, really what I'm interested in is is this two-way auction at this price an imbalance, or is it just normal trade, right? The markets exist to facilitate trade, to transfer risk from one party to another, right? So a lot of the trading that you're seeing is just trading. But when you see something interesting, something unique happen, like an imbalance, that that should prick up your ears and say, hey, you know what? I should probably buy something here, right? I see a lot of people coming in buying. I see a lot of imbalances. It's like, last year during COVID, right before the lockdown, people started buying toilet paper because everybody else was buying toilet paper. Oh, is it buying imbalance in toilet paper? Okay. And all the information that matters really can be derived from these three main pieces of information: delta, point of control, and imbalance. Now, delta, in case you're wondering, is the difference between aggressive buyers and aggressive sellers in a bar. And it's important so you know who is dominating the current market, right? And again, it's when I say it's the difference between aggressive buyers and aggressive sellers, it's also in another way to put it, it's the difference between the volume traded on the offer versus the volume traded on the bid. Okay, and delta, some people like to have delta above and below the bar. I like to have it down here on the bottom. I like to keep it consistent, rather, because bars, go up and down all the time, right? And I just find it better keep it all consistent. I keep the max delta and min delta here as well, because that's going to tell me how strong the buying was in a bar and how weak it was at one point in a bar. But the delta, it's just the headline number. It's the difference of where the bar closed and who was in control of that bar by the time the bar closed. Now, delta is either going to be positive or negative. It can be zero, right? But that's just more of a coincidence that it landed on zero than anything, being, oh my God, delta's at zero. It's perfectly matched. Honestly, this market trades so fast. I found that, when it lands on zero is just, especially if you're using a time-based chart, like a minute-based chart, the bar just closed, right? It doesn't mean anything in that sense. Like, you should get all excited about it. But delta basically tells you who's in control of the bar by the time the bar closed, right? And that's important information because, most people will say, well, yeah, you got a red candle, you should have negative delta. Well, I'm here to tell you, sometimes you have a bar like this green bar here with negative delta, and that means something, right? It's telling you that there was probably some volume down here to stop this move down, right? So imagine if you have that information, see the market is selling off, selling off, selling off, then it hits this level down here, and you see a very big volume traded on the bid, and the market can't get past it. It's got a big negative delta. It's telling you people were selling it, trying to get it to go lower, but nope, somebody just sat there and absorbed all that selling, right? That's information you could take and trade off of. That's absorption, right? People think that, oh, you see the market came off here, it's going sideways, that's absorption. But you can know right here, right now, you have the sign of absorption. You got big, strong negative delta. The market can't push any lower. It's telling you someone's absorbing all that aggressive selling, right? When you see strong negative delta and the market's not moving down, that's absorption. Now, the point of control, the second thing I'll talk about, right? Point of control is the price level in the bar with the most volume. And you don't need any mathematical formula to determine it other than simple arithmetic, right? You just add up the volume that was traded on the bid and the offer. Every bar has a point of control. And you'll see it on each bar. It'll be highlighted, right, in the bar, okay? So again, that's information that you're gonna use and that you can trade off of, right? Now, imbalances, I talked about that a bit earlier, right? They occur when there are more aggressive buyers than sellers, or vice versa, more aggressive sellers than buyers in the two-way auction. Now, a buying imbalance occurs when there's at least 4 times as many traders buying the offer than traders selling the bid. And a selling imbalance occurs when there is at least 4 times as many traders selling the bid than traders buying the offer. Okay, and this is a picture of the tsunami in Japan, and it's really sometimes like this in the market. Even though this is a terrible event that happened, you just get waves of imbalances coming in, aggressive buyers just coming in, lifting all the offers, or waves of aggressive sellers as the market is plummeting, just coming in, hitting every single bid that's there, just looking for a bid. And that's really what it feels like sometimes. Now, imbalances, again, you're going to see in the bar, right? They are the red numbers. Buying imbalances are the blue numbers. The black numbers are just your normal trade, right? What's traded on the bid, what's traded on the offer. Now, generally, as the market rises, you see buying imbalances, right? Aggressive buyers are lifting the best offer and looking for the next best offer, right? Demand is present. Now, generally, as the market falls, you see selling imbalances. Aggressive sellers are selling into the best bid and looking for the next best bid to sell into, right? The sellers, the supply is present in the market, right? So generally, you're going to see the market sell off with aggressive selling, right? But again, like I said, you have aggressive selling down here, but the market's not selling off. That's the information that you got to take as a trader. So, what doesn't happen sometimes is just as important as what does happen, right? You got big selling imbalance here. The market can't go lower. Okay, as a trader, right, the best computer is the one on your shoulders. You got to think, well, what is happening, right? How can I position myself? Well, I know I got a lot of aggressive selling here. The market can't go lower. So there's probably somebody there, a big buyer there absorbing all that activity. And then the market went back up. So, from price delta imbalances, point of control, they all help a trader find consistency, right? Because again, if you're looking at this bar here with a strong aggressive selling, the bar's not going any lower. That's a simple trade to take, right? You get long, your stop is just right below that, right? So it's not like, you're taking a fly. Well, you know what? I've got this candlestick. It looks kind of bullish. The market traded down, went back up. I'll get long off that. Then where are you going to place your stop? You don't know, right? Just as, you get a lot of candlesticks that look bullish or look bearish, but then 5 bars later, it's failed already, right? But knowing what's happening in the order flow allows you to understand where you can place your stop a lot tighter, where you'd be wrong, basically, right? It just makes trading so much easier. And by being able to place your stop closer based on market activity, based on market structure, that's really what all these trading gurus, everybody says, limit your risk, right? Cut your losses short. It's not about just having a tight stop, right? It's about understanding that when the market fails, the reason it's failing is because of XYZ, right? Something's happening in the order flow. Market sentiment has changed rather than just putting in an arbitrary stop set on a dollar amount. Okay, so that's where order flow is going to help you as a trader. So remember, right, in order for a market to move in the direction you expect it to, there needs to be follow through order flow in the direction that you're expecting the market to move, right? Like I said, if you don't have that follow through order flow, the market's not going to move in your direction, right? It's not going to be because you got your super duper X-ray vision indicator in the market that says to buy here for whatever reason. If nobody else is buying along with you, the market's not going to go up, right? Or if you say, oh, my tool here says to get short, right? I drew a trend line, I drew a line in my chart, and it says I got to get short from here. Well, if nobody else is selling, and instead everyone else is buying, you're going to get run over, right? You're going to get stopped out, and you're going to lose on the trade, right? Remember, markets move because of the actual buying and selling that's taking place in the market right now, right? It doesn't move because of an indicator, right? I mean, that's what people, when they talk about indicators lagging, they think that they got an indicator that it's going to help them predict the market, but oftentimes they're so far behind on the market that they're just left behind, right? You're giving up extra potential for profit. Now, the last thing I'll talk about is how to use order flow to become a better trader, right? Like I said, earlier, people say, well, if you're such a good trader, I traded for 25 years at a very high level, JP Morgan, Cargill, Commerzbank, etc. And again, I got a lot of information that I've accumulated over the years. And the way I look at it is, you got to pass that information on to other people, all right? And the markets are so big, so complex. There's enough room at the table for everybody. It's not like if one person becomes successful, another person becomes a failure. No, you know, there's enough food for everybody to eat. But sometimes, people just don't have the food. And, that's why I say, come here, eat some off of my plate, right? Share that information. Now, if you're looking at a normal bar chart, this is yesterday in the E-minis, right? You can see the market is just basically going sideways, then it pops up here, goes sideways some more, pops and goes up, right? Granted, the last couple of days, S&Ps has been pretty quiet. Obviously, you got Jackson Hole coming up, that big meeting. So, it's to be expected. So you can only trade what the market gives you. Sometimes the market's going to be quiet, sometimes it's going to be bonkers. Now, if you're looking at an order flow chart, right, you get a better idea of what's happening in the market. Okay, now this is a bit of an advanced concept here, but if you're looking at what's happening here, if you know this bar, if you can look at this bar, you can see it's a very bullish bar based on the order flow. This is what we call order flow sequencing, where it's just, it lifts every offer that gets lifted is higher, 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 right? So basically what someone's coming in and, people are expecting this market to go lower. That's why they're offering out more here, more here, and more here. But a buyer came in and basically hoovered all that up, okay? Because someone was stacking the order book in anticipation of the market to go down. Now, again, if you're not familiar with order flow, it's hard to see, right? But if you have a software, right, my Orderflows Trader will highlight these areas to you like this, boom. So you know that you got bullish order flow, all right? Now here's another example, right? This is E-minis yesterday. Again, very lifeless market, basically just very boring yesterday. Back and forth, back and forth. But then, hey, you get a little bit of a move. Finally, you get a little bit of a dump from the 94.5, 95 area down to the 92, 92.5 area. But for most traders, trying to figure this out is like, if you're looking at a bar chart, you're thinking, we're just going sideways. Maybe we sell off, come back down to this low, rally back up. But if you're looking at the order flow, it's very clear what was happening in here, right? You got this little bearish activity coming in right in here, right? But again, it takes time to understand that. That's why I created my order flows software, is because I want to be highlighted to those points of control that matter, right? You can see you got a bearish point of control right in here, and boom, it's sold off. Okay, so the next one talk about is crude oil yesterday. Now, crude oil, on days that equities are moving slow, fortunately, you got other markets that you can trade, like crude oil. Crude oil moves quickly sometimes. And yesterday was kind of a normal day in crude and nice price rotations. But again, market just looks like it's going sideways in here, right? Nothing really to get too excited about, right? In the order flow, you're seeing points of control sort of matched up, delta, not really too much directional one way or the other. Not necessarily a whole lot of imbalances, but again, there's just that one little market nuance that tells you this point of control, what's happening down in here is bullish, right? Right before you rally about 30 points in the next 5 minutes, right? That's the benefit of using order flow, because a question a lot of people ask is, Mike, I use a 15-minute chart or 30-minute chart. Can I use order flow? Well, you can. There's ways to use it, but the best way to use order flow is right now, right? Trade what's happening right in front of you, basically. Take advantage of that information, that bullish information or the bearish information, and trade off of it rather than waiting for this market to rally up here and say, hey, it looks like we got to break out of this range. And then by that time, you've already given up an extra 10 ticks of potential profit. This is soybeans, right? Very similar to, crude oil that I was just showing you here, right? Basically a sideways market, and then it pops up, right? A little sideways market, then it pops up. Okay. Well, if you had software that can show you this activity, right? You're seeing sort of sideways market, but it's getting ready for a pop, right? That's why it highlights this point of control green. It's telling you, hey, wake up. This market's potentially getting ready to rally. And it rallies, Again, it's a nice move, almost a 10-cent move, which is $500 move in soybeans, and it happens basically 1, 2, 3, 4, 5, 6, 7 minutes. And then you get a bearish signal here, right? Once we rallied up 10 cents, it sort of went sideways, but now you're getting a bearish signal here, and the market sold off again back down to the 20s. So again, that's why having software that can help you analyze the market is just going to put you so far ahead of a lot of traders that are waiting for this breakout, right? Imagine you're trading this market, right? And you have your, oh, you say 28 is the high, I'm going to wait for a breakout, okay? And you get long at 29. Well, you should have been long from 27, 28, rather than 29 or 30, right? So it's going to help you understand where the activity is happening so that you can take advantage of it as soon as it happens, right? Because that's what you want to do, right? You want to take advantage of what's happening as quickly as possible. Now, the next thing I'll talk about is imbalances, all right? And again, you see a lot of bars have both buying and selling imbalances, but then you're going to notice some bars have a lot of buying imbalances, directional imbalances, or a lot of selling imbalances, directional in the opposite direction. And again, if you're newer to order flow, or even if you've been using order flow for a while, most traders are familiar with a stacked imbalance, which is 3 or more imbalances stacked neatly on top of each other. And while it's pretty on a chart, a lot of times you don't get those imbalances stacked neatly on top of each other. Sometimes they're spread out. 1, 2, 3, right? There's 1, and then 2 and 3 up here. Now, if you're looking for stacked imbalance, it doesn't happen until way up here, or in another one up here. But by this time, the market's already moved from 28.5 all the way up to 31.5, 32. Would you rather be alerted to, hey, you know what, there's already aggressive buying coming in here that matters, getting long now, and then enjoying that stacked imbalances when they come in here, right? These are the bars that you love as a trader, right? The bars that, in this case, open at 29, close at, almost 35. Those big bars in your direction when you're positioned that happen so fast. And then what happens? Market goes up, then goes sideways, it starts coming down. Then you're starting to see the selling imbalances coming in this bar. You got 1, 2, 3. So I got my software will highlight it, the bar. It'll put just a simple box around it, right? It doesn't need to be anything fancy. Traders like to overcomplicate things. Keep it simple, right? Keep it simple. You don't get a stacked imbalance till over here, but you're already alerted to, hey, you know what? There's a lot of selling coming in now, around the 32 area rather than 29.5. So it's coming in, you're coming in 2-3 cents ahead of time, right? You're getting short ahead of time, and all that information is available to you. It's not like you're trading on inside information. No, this is what traded, but if you're not looking for that information, you can't profit from it. This is crude oil yesterday, right? Nice move up, right? From basically, the 65 area all the way up to the 6800, 67.65 to 6800, nice 35-cent move in about 10 minutes, 15 minutes. But unless you picked up that there was the aggressive buying was coming in force in the form of multiple imbalances, you're not going to notice it, right? Here, this bar, this bar, this bar. Again, if you're trading for a breakout, maybe you're missing it. Maybe you're getting in later. You're giving up ticks, right? And again, why should you, that's why I talk about, money being on the table is, you want to take advantage of everything that's out there, right? All the tools, all the information that's out there, because, we're in an arms race right now in terms of data, right? And individual retail traders, we can't compete with the big hedge funds, the quant funds, people that are running these supercomputers to analyze data and all that. And I'll be honest, all this information you're seeing on a footprint chart is being analyzed as well by other professional traders with bigger budgets, bigger computing power than all of us. So if you're not looking at this information, you're really going to be left in the dust one day if you're a short-term intraday trader. Again, this is 6E, right? The euro currency futures on the CME. All right, and again, if you can pick up that, hey, you know what, there's aggressive buying coming in here, right after this little bit of a pullback, as the market's pulling back, are you thinking, well, is this just a pullback and we're going to go back up, or is this the market falling over? But you can see here, look at this. Each bar over this 5-minute period has very strong aggressive buying. Multiple imbalances, multiple imbalances, multiple imbalances, multiple imbalances, multiple imbalances, right? As this market keeps going up and up and up. Again, now this is gold, right? You can see it here, right? Right before the market sold off from this 97 area down into the, below 90. This was your clue right here, right? The multiple imbalances, right? Mini Dow yesterday, right? Same thing. Market rallied up about 50 points. Your clue was here in this bar, multiple imbalances. Say you missed this bar, you get in here, right? There's still points to be had. All right, so it happens in all markets every day. There consist of people trading the market, right? And their behavior, while not exactly 100% repeatable, is very fractal in nature, right? It does repeat itself. A lot of these charts I showed you look very alike, right? This chart looks a lot like this chart, right? This is the crude oil, right? This is the euro currency. This one's at 8:50 in the morning, right? 8:50, 9 o'clock in the morning in the euro currency. Whoops, crude oil. It happened 2 hours later, right? 10:50 in the morning, and it looks very similar, right? But you see it over and over and over in the markets, right? And this gold chart, it looks the same if you were to flip over the euro currency and the crude chart, right? It looks very similar. In this case, it's selling imbalances that are coming in. So, to be honest, there's just so much more I'd love to show you, but there's just not enough time today, right? So hopefully you can see how powerful order flow analysis really is, right? Again, don't need to overcomplicate trading. Just trade what you're seeing, right? Just trade what's happening right in front of you. So if you found this helpful, you're going to really like the Orderflows Trader 3.0 software package, which makes order flow analysis so easy, right? Because order flow provides the trader advanced information that they need to get an edge over other traders. Everyone always says, open up a book, open up whatever, video, you need an edge. Okay, well, how do I get an edge? Well, I just showed you how you could get an edge using just imbalances or points of control, right? And there's a lot of other ways you could use order flow to get those edges, because order flow allows you to see and understand what's happening in the market that other traders don't see. So hopefully, let me ask this question, right? Who wants to add order flow analysis to their trading, right? Hopefully everybody. So you could do this on your own. You could spend a year looking at a screen trying to figure out order flow. But honestly, what's going to happen is you're going to waste a year losing more money, right? And when I ask you next year, how's it going? You're going to be like Sylvester Stallone, all beat up and shot. Yeah, it's going good, even though you just blew up a couple trading accounts, etc. Now, or two, you could get the education and software from a trader who has successfully traded order flow at the highest level for decades, right? You're going to skip the massive trading losses, skip the wasted time. So the Orderflows Trader 3.0 runs on NinjaTrader, okay? Runs on the NinjaTrader 8. It's a volume footprint chart with 17 pre-programmed order flow indicators. I talked about 2 today. I talked about the point of control one, which is the slingshot point of control, and I talked about the imbalances, all right, the multiple imbalances. I say you get my chart template, but honestly, in this new version, you don't need a chart template, because when you install the software, the defaults are my defaults set up for an E-mini 1-minute chart. And normally the software sells for $8.99 on my website, but you're not going to pay that today, right? But I realize, right, having order flow is one thing, right? You have to know how to use it, know what you're looking at. So I'll just give you the software and send you on your way. I provide a lot of education on how to trade with order flow, right? And each week I do a live group training session for users, right? So if you can't attend, you could watch the recording. As of this week, I've got 133 recordings. So you can see it goes back how many years, right? It goes back to 2018, actually. Now, I don't expect you to watch every one, but it's there as a resource for you. And each week, again, you could come in and watch it, attend it, right? You got questions, want me to ask me, Mike, what about this market? What chart should I be using? If I'm looking at, wheat or something, what do you recommend? Or what settings should I be looking at? Because there's a lot of different settings for different markets that some perform better than others. Now, some people will sell you software and say, oh yeah, you want my training, it's going to cost you extra. No, it's free, right? It should be free, right? You buy the software, you make the investment in yourself in software, they should give you training with it, right? And that's what I do, right? So again, if you can't reach me for whatever reason, saying, you can always find me there. I'm always there Tuesday nights, 7 p.m. Chicago time. So that's the live training, right? And I also got recorded training, right? My Orderflows trading course, which I also sell for $297. You can get that for free, right? It's a 20 lesson course on trading order flow. And for those that want to sort of step it up, you also get access to the Inner Circle video series, which I did a few years ago. There's 56 videos on advanced order flow tricks, tips, and analysis. You get access to that for free as well. So you start adding that up, right? The software, the training, the video series, and the weekly group training. It's $1,600, $1,700, close to $2,000. But again, you're not going to pay that today. And because Anna keeps having me back, I got even a special bonus for you, right? My Investors Expo bonus, which is the Order Flows Playbook. You're gonna get that for free. I sell this for $297, right? And I sell copies, all the time. I'm gonna give you that for free. So, you're close to paying close to $2,000, right? But again, I don't want you to pay that. Now, other people are saying, the training, the software is great because they can clearly see now what's happening in the market, right? Because at the end of the day, that's what you want to do, is you want to understand what's happening in the market. So again, it's up to you, right? Everyone's got dreams of financial freedom and success, but at the end of the day, it's up to you. You got to make it happen, right? You got to take that step, make that investment in yourself. So for just a one-time payment of $749, you're going to get it. Right? You're gonna get access to all that information, right? Just go to orderflows.com/oft3. And the link is there in the chat. I put it in there. I think Anna's got it in there as well. And go to it. It takes you to a page. Just looks just like this. What you're gonna do is you're gonna scroll down, right? There's a little thing here. You just scroll down. It's gonna take you to this button. Click here to buy now. Now there's videos and other instruction on there if you want to learn more about the software. And when you click on that button that says buy now, it takes you to PayPal, right? PayPal processes your payment, not me. I don't get your credit card. I don't want your credit card information. I'm just here to trade basically. Now, if you're interested in my book on order flow, it's a great way to understand order flow for beginners. Even advanced traders will get a kick out of it. Go to orderflows.com/book.html and you got to enter your name and email address. You just don't go to this page and it's right there. You got to enter your name and email address. Then you got to hit submit. All right, then it takes you to the page where you can download the book. So act now, right? Basically, you got to do something. You got to take that step forward, right? Because we've been on. COVID happened last year. Everyone was on lockdown, right? Some people started to trade. Some people made money. A lot of people lost money. But really, trading is a life skill that you could have with you for the rest of your life, right? Whether you're 40, 50, 60, 70, as long as you know how to trade, you're golden, basically. So go to www.orderflows.com/off3.html, and I'll see you guys on the.
So yeah, good afternoon, risk managers. I always refer to my students and trader friends as risk managers because the bottom line and the end result is that's what you are. If you're going to trade in the stock market as an investor, short-term trader, etc., forex, crypto, futures, options, you got to be a risk manager first and foremost. Correct? So welcome everybody. My name is Daniel Sugar. Great to be with everybody. So my screen's working, the audio's working, fantastic. All right. So my website's trendlinebreak.com, and trend lines and patterns is what I'm all about, basically, keeping it simple. I learned trend lines from a very successful hedge fund manager for 3 years down here in South Florida, and that really helped me propel my trading a lot. So let's dive in. We only got 45 minutes. We got a lot of great information to cover, so let's dive right in. I was thinking, how many folks out there have watched the 3 other presentations, and I'm the 4th one, and if you need a little 2-minute break to get some water or so forth, how many people have watched all, this is your 4th one in the last 2.5 hours or so. Take a break and get some water. But a lot of great information from Investors Expos. So there's my little disclaimer. Trading can be risky. Only use risk capital. You got to manage your risk. If you don't manage risk, you're not going to have any risk to manage, right? So that's very, very important. There's an old floor pick. I spent a decade on the floor in Chicago. If you can tell my accent and my dialect, I'm from Chicago originally. One of my students made this little, my company's called LaSalle Wacker Trading and Teaching. So he made this little thing for me, and I put it in the upper corner here of the floor. So that's kind of neat with a little trend line there. So welcome, Thursday the 26th. There's my website, my email address, dan@trendlinebreak.com. And if anybody's ever been to Chicago, I always get some questions about how'd you come up with LaSalle Wacker Trading and Teaching. Well, the Board of Trade is on LaSalle in Chicago. The Wacker is where the Chicago Merc is. I grew up in Lincolnwood, Chicago, the first suburb north of the city, LW Lincolnwood. And trading is all about winners and losers. So a lot of LW going through there. So I named my LLC LaSalle Wacker Trading and Teaching. But there's the website and the email address. My mantra and my vision statement is basically integrity, transparency, and performance. That's what we're all about. Who am I and why should you listen to me today for 45 minutes? Before we go too much further, let me just take 15 seconds to introduce myself so you know who I am and why you should listen to me. My name's Daniel Sugar. I'm a 3rd-generation Chicago floor trader who spent 14 years on the floor at the Board of Trade. My grandfather, Samuel, traded butter and eggs at the Chicago Butter and Egg Board in the early 1900s, which eventually became the Chicago Mercantile Exchange. So before there was S&P and bonds and Japanese yen and pork bellies, there was butter and eggs back in the day, as they say. And then my father was a floor trader starting in 1950 in soybeans and corn and the grain floor at the Board of Trade for 35 years. Him and his partner were the largest spread brokers in the soybean pit. And he struggled in the 50s and 60s, making a couple bucks in there, making a small living, very modest living. But then when he was in his late 40s or early 50s, in the 70s, the grain markets really went wild with a lot of volatility, grain embargoes and all kinds of stuff. So the grain market in the 70s, corn, wheat, and soybeans was kind of like the NASDAQ in 95 to 2000 or so. So a lot of volatility. But I took those DNA tests, and my DNA came back XYT, T for trader. So trading's in my DNA, literally. So I hope your charts don't look like this, folks. A lot of people's charts have Elliott wave and Fibonacci and Bollinger Bands and moving averages and trend channel lines, etc. But you really want to keep it simple, folks. I like my charts nice and clean. I'm an old school technician, purist. It's all about price action, trends, and some patterns, which I'm going to cover today. So I would definitely take some notes, folks. We're going to go at a decent pace here. We got 45 minutes, but take some notes. I'll keep an eye on the questions and try to keep the questions on the current topic, and that'll make for the best experience this afternoon. So I'll keep an eye on those questions. Sure, so I apologize. I got a couple Bernedoodles that get a little crazy when they see other dogs being walked out my office window. So I do apologize for my Bernedoodles barking once in a while. So if this is your 4th presentation today, or maybe your 3rd, let me take 90 seconds and show a couple funny PDFs here. So here's a gentleman in court. He's the defendant, and he looks back at his attorney and says, "Don't worry, I've watched a lot of Law and Order. I got this. Right? Here's another one. Here's a patient looking into the eyes of his surgeon. Of course I can remove your blood clot. I've got Wikipedia, right? And the last one, I've just finished the YouTube video on 747s. Buckle your seatbelt. We'll be taking off shortly. Like, my point is, folks, you know, to become an engineer, you got to go to some school and get some education. To become a plumber, you got to be an apprentice and learn under a mentor. To be a restaurateur, to be a broker, real estate broker, anything in this world, you got to get some proper education and knowledge to do well and be successful. So for some reason, people think they can open up an account at, you know, Robinhood or Charles Schwab or Fidelity or Scottrade, whatever, TD Ameritrade with, you know, 25 grand and start listening to Jim Cramer and do a couple free YouTube videos and start making money. And usually that's not where it goes. So the trading, investing, education industry is very large. I've heard some estimates around $50 to $75 billion in investing and trading education. Unfortunately, there's some snake oil salesmen and unscrupulous scammers out there. That fact really motivates and drives me to show my students there are some honest mentors out there with integrity. I'm very proud of the reputation I've built over the last 14 years teaching and being a mentor and educator and coach since basically 2008. So I'm 90% trader, 10% salesman is my little inside joke there. But there's a lot of good people out there. Don't get me wrong. There's a lot of good people that are like myself, have their students' best interest at heart. But sometimes people get in that trap of jumping from mentor to mentor and spending money, and then they have a little remorse because it didn't really benefit them. But I try to be the last stop for people, and I'll show you some testimonials in a few minutes later on. But I'm an honest, straight shooter from Chicago. My parents raised a pretty honest. Honesty is the best policy, and so I just wanted to lay that foundation. So here's a nice little trifecta of things. You know, you have to have an edge in trading. You have to have a methodology or a strategy that has an edge. You know, you got to have risk management as one portion. You have to have a trading methodology or strategy, whether that's Bollinger Bands or order flows or moving average crossover or MACD or RSI divergence or trend lines and patterns, which is my thing. So you have to have a strategy and a method. And then you also have the proper mindset and trading psychology. Some of you folks have been trading live for a couple of years or a couple of months. Some of you folks are in your knowledge absorption and education phase, trying to get as much education and knowledge out there before you risk any money, you know, which is good. Go in simulation mode and test your strategies and so forth. But you have to put all these three things together: methodology, strategy, with risk management, and psychology and mindset. And those three things will create your edge over uneducated investors and traders. Okay. So in the next 45 minutes, we're going to cover how institutions, hedge funds, and successful traders and investors identify the macro trend and draw trend lines accurately to make consistent profits in the markets, whether it's Forex, futures, options, stocks, or even now crypto and Bitcoin. And you can use trend lines and patterns on any time frame, whether you're an intraday trader on a 5-minute or 15 or 30-minute chart, or a volume chart, or a short-term swing trader from 2 or 3 days to 2 or 3 weeks, or maybe a short-term position trader from, you know, 4 weeks to 12 or 16 weeks, or an investor. All four of the above. You can use trend lines and patterns, so they're fractal. You know, is a good word to use. They're fractal. You can use them on any time frame and any market. Okay, and some people say, well, Dan, trend lines are, you know, very, very subjective. You know, and I say, well, they can be if you don't know how to draw them correctly. They can be very subjective, but once you know how to draw them, they're very objective, right? And it takes time and a little practice, but the beauty's in the simplicity. And we're also going to talk about how institutions and hedge funds and the smart money implement and execute risk management on every trade to avoid the big losses, so you can be successful year after year and never have to worry about, you know, your main job or career, and just extract money from the markets every month, every quarter. That's the main goal. You want to get to that, you know, unconscious competence level. You guys have heard those four levels. There's unconsciously incompetent. You don't know what you're doing at all. Then you can go to consciously incompetent. You know, you think you know, but not really. and then you can go to consciously competent, which is pretty good to strive for. If you can get to there, that spot is very good. Consciously competent, and then the ultimate peak of the pyramid, so to speak, the peak of the mountain, you want to be unconscious competence. You can look at a chart, you can see a trade, you know how to manage the risk, you know how to execute your trade, and you manage your motion, and that's where you want to get to. So, but it takes time, definitely takes time. Here's my little pyramid to profits, folks. Speaking of the pyramid and the mountain, came up with this years ago, but you want to have the foundation. You have to have a process, whether it's a pre-market routine, maybe you're busy in the morning with kids or work, maybe you do it at night, but you have to come down to get down to a process. If you're a very process-oriented person, you know, that's a very good thing to be right now as you're trading. But if you're not, you need to get some kind of process to help you flow and go from task, you know, 1, 2, and 3, and so forth. Then you got to be prepared, right? You got to have preparation. You got to have patience. You know, patience is a very, very key thing in trading and investing. Very, very much so. The proper psychology and mindset, right? They're very important. Successful trading is all about probabilities. If you have a background in game theory or gaming theory, or you're a good blackjack player in Vegas, or you're a good Texas Hold'em player, that's not going to be a bad thing. That's actually a good thing, because there are some parallels between, you know, gambling and successful trading. Successful trading is not being a gambler, but there are definitely a couple parallels between both of those endeavors. And then patterns we're going to talk about today all lead to performance, right? And then, you know, trading is a very performance-based endeavor. You know your bottom line after every day or every week or every month or every quarter with your statements, of course, and your account balance, and that all leads to profit. So this is a nice little, I have this in a PNG or PDF document, so you can email me and I'll be happy to send you this document so you can print it out. But it's very, very important, or take a screenshot. But this is the pyramid to profits right there. If you focus on making money, profits never come. Focus on locating and identifying good, low risk, above average reward, and above average probability opportunities. Okay, that's the main goal, folks, whether you're trading the euro or Bitcoin or mini S&P futures or the IBM or Microsoft or Shopify. Focus on low risk, above average reward, and above average probability setups and opportunities, okay? And you want to execute that plan, and then once you have a trade on, manage your risk, manage your emotions. Very, very important. A couple more trading success rules. Number one, you have to have a strategy and the discipline to follow it, right? What good is a strategy if you're not going to follow it? So that's your edge. Again, whether it's Bollinger Bands, order flows, moving averages, Elliott wave, Fibonacci, trend lines and patterns. Have a strategy that has an edge, and you have to have the discipline to follow it. Risk management, love your small losses. You got to watch your downside, folks. Trading can be very risky if you don't know how to manage risk, but I want you guys to have a PhD in risk management and an MBA in trend lines and patterns after our 45 minutes together. Well, maybe at least a GED, because it's a short 45 minutes. Proper position sizing, very, very important. Don't trade too large. You know, we talk about 0.5 to 2% of your account on any given trade. So in other words, if you're trading with $15,000, 1% will be $150 is your stop maximum. 2% will be $300. If you're trading with 50 grand, you know, 1% is $500. That's your maximum stop. 2% will be $1,000. Good risk reward setups, 3-to-1 minimum, risk 250 to make 750, risk 1,000 to make 3,000. You know, if I risk $500, is my expectation of profit $1,500? If it's not, move on to the next chart, the next trade. Patience and psychology, very, very important. It's hard work. Get in front of your charts, do your top-down analysis with your process. And again, the main goal is to always look and identify low risk, above average reward, above average probability opportunities. And you guys are already, you know, passion and dedication, because you've already taken some time to sit in on some webinars, of course. So successful traders, anybody that I know that's successful, or I've read books on successful traders like Market Wizards, etc., they narrow their focus, right? You don't want to be a jack of all trades and a master of none. I love that old saying. But whether it's order flow, like you may have just seen, MACD, RSI, Bollinger Band, stochastics, one of those maybe. Maybe you like moving averages or market profile or volume profile. Those are very good. I use those. Fibonacci might be your thing. And then my thing is trend lines and patterns, and then classical technical analysis, candlestick patterns like tweezer tops, shooting stars, hammer bottoms. Very, very important. You know, one candle can reveal a lot of information and knowledge about who's in control, the bulls or the bears, and where's the path of least resistance. So my thing is keep it simple, students, right? I believe in the KISS method. Keep it simple, students, right? But the successful traders, they master one or two things. One or two things they master, and then lather, rinse, repeat. And they just do it over and over and over, right? You know, successful trading, you know, can be kind of boring after a while. I mean, don't get me wrong, folks. Making money ain't boring. I got, you know, definitely not. But the process of just getting in front of your screen, looking at your monthly, weekly, daily, or weekly, daily, 240, or whatever your 3 time frames. I'm a big believer in multiple time frame analysis. The process can be a little, you know, remote and whatever and repetitive. You know, making money's not, but it's a great challenge and it's a big mind game and psychology we'll talk about. But the process can be a little, you know, boring at times, but that's okay. You got to be passionate, dedicated about it. But focus on one or two strategies, get really good at them, and become a specialist, like a New York Stock Exchange specialist. You know, you want to specialize in one or two strategies. You know, when you're first starting out, definitely, and just really become an expert and specialize. So here's a little couple sentences from John Murphy from stockcharts.com. He was on CNBC for many years in the 80s and 90s. John J. Murphy wrote Technical Analysis of the Financial Markets. He's one of the you know, technical analysis. He's one of the fathers of technical analysis, John Murphy, and he's written a couple good books. But he basically says 2 basic premises of chart analysis are that markets trend and that trends tend to persist. Right, a trend in motion tends to stay in motion until acted upon by an outside force. We'll mix in some biology and some chemistry for you guys. All right, I'm kidding. I know it's a different science, but I know it's Isaac Newton. But seriously, a trend in motion tends to stay in motion until acted upon by an outside force. Right? Trend analysis is really what chart analysis is all about. Trends are characterized by a series of peaks and troughs, highs and lows, if you will. An uptrend is a series of rising peaks and troughs, or higher highs and higher lows. That's all it is. You can be able to look at a chart and see, are we in a trading range? Are we in a downtrend? Are we in an uptrend? A downtrend shows descending peaks and troughs, lower highs and lower lows. Finally, trends can be classified into 3 categories: major, like the monthly or yearly; secondary; and then minor. So, you know, I like to call it the macro and the micro trend. The macro is the big picture, and the micro is the smaller time frame, maybe a couple days to a couple of weeks. And then here's a couple more quotes from John Murphy as well from one of his books. The trend line is perhaps the simplest and most valuable tool available to the chartist or available to the trader. Simplest and most valuable. And this is from John Murphy, one of the fathers of technical analysis. There's Charles Dow, there's Edwards and McGee, for you folks that have been around the markets for a while. And there's Richard Schabacker from years ago, 1900, 1920, volume and so forth. But John Murphy has made a name for himself, and he's one of the fathers of technical analysis, absolutely. The second quote, the violation of a trend line is often the best warning of a change in trend, from an uptrend back to a downtrend, or from a downtrend back to an uptrend. And I'm going to show you several examples of that coming up on some charts. But simplest and most valuable, and a trend line break is the best warning of a change in direction or a change in trend. Here's a couple examples. Here's the mini S&P on a 3-hour chart, 180. Over here, So there's a nice little trend line here, a little break, come back up one more time, and then a big drop, base drop here. And the trend line broke around 34.04, 34.03, drop, base drop down to 33.15. So there's like a 75-point drop here in 15 or 18 hours. A nice little bounce here, a couple highs around 33.60, 33.58, connect these lows, and then there's a nice trend line break around 33.38. If I go to the right, there's a scale, 33.40, a couple points below there, 33.38, down to 32.80. So that's a nice 50-point drop in 6 hours. A little dead cat bounce, short covering rally, 3 more touches. Here's another trend line break coming down below 33.08, down to 32.45. So here's a 55-point drop. And then we go back up, a little double top up here around 33.15, 33.20. And then there's one more trend line break to the downside below 33.05. And we eventually made it down to 3,200. So there's a 100-point drop, folks, in 18 hours, 24 hours. And this is, recently. Actually, I'm sorry, that's last year. That's September of 2020. That's September of 2020. So about a year ago, 11 months ago. And then here we got above a downtrend line. There's 4 or 5 touches. Once we got above 32.42, 32.43, we popped to 32.95. So there's a 45-point rip back to the upside once we cleared that downtrend line. Okay, so that's how I like to see my students' charts. Nice and clean and simple. It's all about price action. Here's Bitcoin on a 4-hour chart. Here's Bitcoin a couple months ago. Here's a nice wedge or symmetrical triangle we're going to cover in a few minutes, which is just lower highs and higher lows. Lower highs and higher lows, you get a breakout. If this, then that, the old Boolean phrase for programming, a lot of parallels to trading, like if this, then that. If we get above the downtrend line, there might be a nice breakout to the upside. Or if we get below the uptrend line, there might be a nice downside move. Let the price action direct you on where the market's trying to go, right? Be in flow with the market. Mindfulness trading. What's really happening? Are the bulls in control and the dips are being bought up, or the bears in control and the rallies are being sold into? So there's a nice break on Bitcoin above 31,500, and we went to 42,000, up and away. And then up here we get a little symmetrical triangle or a wedge, which is just 2 intersecting trend lines. Lower highs, trend line, I want you to meet higher lows. And there's a nice breakdown below 41,000. And, I'm a big collector of old classic Wall Street and trading cliches and adages. One of my favorites is the market takes the stairs up and the elevator down. The markets take the stairs up and the elevator down. Sometimes it's the express elevator. Why is that? Well, greed's powerful, but fear is 2.5 or 3 or sometimes 4 times as powerful as greed. So panic and fear drive markets. So there's a big wedge breakdown on Bitcoin a couple months ago, January, 9 months ago, below 41,000. Drop, base drop down to 30,000. So there's a 25% correction. This is a 4-hour chart. So this is like a day and a half or 2 days, right? But a big TLB coming out of the wedge. Here's one more. Nice bounce back up, double top. Once we got below 35,000, we went down to 32. So there's a 300-point drop. Another nice rally back up. Here's a trend line covering the lows. The lows are in control. There's the break below 38.6, 38.5. We went to 34 and change. So here's over 400-point drop on Bitcoin, and then a nice little bounce back up. Triple top at 38,000. Here's a flip zone. Old lows became new highs. Old support becomes new resistance. That's technical analysis 101. Doesn't happen all the time. Doesn't work. Nothing works every time, but old floors become new ceilings many, many times. And here's the TLB trendline break below 37,000. So that's Bitcoin. Here's Microsoft on a weekly. I want to give you guys several examples on weeklies, dailies, 60-minute, 30-minute, 180, different asset classes, Bitcoin, Microsoft, etc., S&P. Here's several trend lines. Here's a nice uptrend from 130, 125 up to 300. Here it doubled. And here's a weekly chart. So each candle is 1 week of data. Okay. And there's some nice trend lines in here. Nice pattern. Here's a wedge right in here. We had a nice rally. The markets like to get tighter and tighter, and there's lower highs and higher lows right there. It's getting tighter and tighter until you get that inertia breakout. And we went from 222 to 245. There's a 25-point rally, a little pullback. Here's your pullback. Old highs became new lows. That's called the breakout retest. Breakout retest. Sometimes you break out and you don't retest. You just keep going. Half the time or so, 60% of the time, you get a breakout and then it comes back and retest. The market likes to come back and visit the scene of the crime, so to speak. The markets like to come back and revisit the breakout area. And then there's another rally. There's four down weeks over here. And we got above this downtrend line at 245 and went to 295, up and away once we got above that downtrend line. So patterns and trend lines, they're out there. Higher time frames are very, very important. Higher time frames are very, very important. Here's NVIDIA on a daily chart. So there's a nice rally. Here's another wedge. Lower highs meets higher lows. There's the breakout around 400, 405 up to 450. There's a $45 rally on a $400 stock, 10%, a little pullback, a monster parabolic move. Here's a phenomenal double top. One of my other favorite sayings I learned on the floor was price has memory, folks. Price has memory. What does that mean? Well, old highs and lows are very, very important. Old highs and lows are very, very important, folks. So keep that in mind. Double tops and double bottoms. And here's a recent trendline break back 540 down to 514. There's a $25 drop right in here with a trendline break to the downside. Here's another nice quote. I forget who this is from, but chart patterns form because people react to price movements in consistent ways based mostly on fear, greed, and herd mentality. Knowing this, we can then focus our attention on chart pattern formations and take advantage of the resulting opportunities. And one other quote I learned from this very successful hedge fund manager that I was a student of years ago, 2010 to 2013, Richard Scalone. He took $1 million hedge fund to $1 billion in 10 years. He was a foreign currency specialist at JP Morgan on the currency desk for 10 years. He learned how to trade like an institution. Then he opened up his own hedge fund in 1999 and ran it to 2009, 10 years. And honestly, he took it from $1 million to $1 billion, and he retired at 44. He loved teaching and sharing his knowledge. And I met him at a proprietary Forex trading room in Boca Raton down here in South Florida in 2010, and I learned trend lines from him. He used to say, if you don't make money when it's easy, you're not going to make it when it's hard. Think about that, folks. You know, depending on where you are in your learning curve, how long you've been trading, how long you've been looking at charts, once you get to know your methodology and strategy, sometimes a couple times a week, a couple times a month, there's some layups or slam dunk trades where you're just very confident it's going up or very confident it's going down. And you got to hit them when there's, make hay when there's sunshine, right? If you don't make money when it's easy, you're not going to make it when it's hard. Be patient, wait for those high probability setups. Here's my favorite 5 chart patterns: ascending and descending triangles, little geometry, bull and bear flags, and then the symmetrical triangle or wedge, which you already saw. So symmetrical triangle or wedge are used synonymous. Sometimes they're also called pennants. And there's bull and bear flags, and there's ascending and descending triangles. One thing to keep in mind with patterns, folks, is patterns fall into 2 categories: continuation patterns or reversal patterns. Like double tops and double bottoms are reversal patterns. Bull flags and bear flags are continuation patterns. And you'll see what I mean when you see a couple examples. Ascending and descending triangles are continuation patterns. Here's the March euro currency a couple years ago on the 3-hour chart. A nice drop, and then you have lower highs with the same floor. There's 1, 2, 3, 4, 5 lows around 113 area, give or take 5 ticks on either side. And then once the floor gives, there's a nice drop. Descending triangle, lower highs with the same lows. When the floor gives, you go short 5 ticks below the low. Risk 10 or 12 ticks, and this thing went from 112.95 to 112.35. So there's a quick 60 points in 6 hours on 10 points of risk. Here's a wedge on the March Euro 60-minute chart. Here's a nice drop, a little consolidation, lower highs meets higher lows, and look at that drop, folks, 113.10. Stop is 113.18, so 8 ticks of risk, maybe 10 ticks of risk, and it went from 113.10 to 112.20. There's 90 points in 1, 2, 3, 4, 5 hours on 10 ticks of risk. 9-to-1 trade in a couple hours. Here's a bull flag, folks. Mini S&P 5-minute chart. Here's the pull, rally, rally, impulsive move. Here's a little correction. Lower highs and lower lows, okay? Rally, a little lower high, lower low. The bull flag, here's the pull. Here's the flag portion. There's the breakout above 68, 68.5. And in 20 minutes, we're at 74. So there's about 6 points, 5.5, 6 points. But it's straight up. You were never down money on that. Some of these patterns and trend lines, you're never down money, which is nice. Sometimes you got to take a little heat on some trades, right? Your stop is 250. You're down 175. Now you're back to a scratch. Now you're up 150. Now you're down, 225. Your stop's at 250. You come close to it, and then the market takes off, and you make $600. Other trades, it goes your way pretty darn close to your entry, and you never have to, never have to take any heat, as we say. This is a great chart of crude oil a couple years ago on a 3-hour chart. There's a bear flag, drop, base drop, impulsive move lower, a little dead cat bounce higher. Higher highs and higher lows, folks, is normally an uptrend, but there's always a caveat with this trading game and charting. If you break that trend line coming out of the bear flag, there's your entry around 59.50, and this thing went to 57 in 3 hours. 2,500 per contract on a CL with about 12 ticks of risk, 120. Another bear flag. Impulse, dead cat bounce, short covering rally. This one broke around 57.90, 57.85. We went down to 56.10. There's a $1.60 drop, 1,600 in 9 hours. Another dead cat bounce, short covering rally. See these patterns? 3 bear flags within a day and a half of each other. They're beautiful things, folks. They're beautiful things. Here's one of my most successful students, Matty Fish out of Long Island. He struggled for 10 years at Charles Schwab. He took some class at New York Institute of Finance. He took some classes at Online Trading Academy, where I used to work for 12 years as independent contractor. And he took my class in the fall of 2016. And then he retook it again in March of 2017 online, and he's never looked back. He struggled for a decade, and now he's been rocking for 6 years now, 5.5 years. And now he's my partner in our swing trading group. And we got a phenomenal track record since last October of 2020, which I can show you. And then again, he loved my trend lines, patterns, position sizing, and psychology as the main reasons for success. Now he's my partner in swing trading. So here's a little investment in mentoring, training, motivation, advice, leads to success, direction, coaching, support, and helping you meet your goals, right? I've personally been very blessed to have a few exceptional mentors and coaches on my journey, starting with my father, Justin. I can't remember if I was 10, 11, or 12 when I first heard at the dinner table, cut your losses, let your winners run, right? One of the oldest adages in the business. But my dad was a good man, born in, smack dab in the Depression. And like I said earlier, he struggled. He already had 2 kids by 1960, my older brother and sister, and making a small, modest living as a broker and trader in wheat and corn in the 50s and 60s. But then he was in the right spot at the right time, paid his dues, and then in the 70s, he rocked out for a decade as the largest spread broker in the bean pit. I also had 2 awesome floor traders that I could talk to when I first started out my career in my mid-20s in the bond pit, who taught me a lot and I could talk to every day and every week. We cleared our trades through the same clearing firm, and I would see him up in the office a lot during lunch and so forth. Then years later, I had the opportunity to work with a very successful hedge fund manager, which I mentioned, Richard Scalone, and he took me under his wing and taught me so much about trend lines, patterns, position sizing, and risk management. I love giving back. People ask me, why do I do this? If I make so much money trading, why do I do this? Well, A, it's nice to have multiple streams of income, of course. B, I get a lot of, professional satisfaction from sharing my knowledge and, giving back or paying it forward, a lot of karma. I believe the positive energy you give out in the world comes back to you tenfold. And again, I derive a tremendous amount of professional and personal satisfaction from sharing my knowledge and helping people succeed in this tough business of trading. If you're serious about becoming a successful trader or investor and are coachable, then you need to invest in some high quality education and be mentored by a seasoned professional who's not only a great trader, but also a good teacher. What is that old saying, that old Chinese proverb? When the student is ready, the instructor will appear, right? When the student's ready, the instructor will appear. Here's a couple testimonials briefly, and I'm not going to read them all, but I got a 10-page Word document over 14 years of doing this of several folks that I've helped. And the underlying theme, folks, is many of them said that I was the game changer, whether it was trend lines, patterns, a little psychology, a 7-day class with me or a 4-day class online with me. That was their game changer. And I'm not saying all my students make money. I'm not going to insult your intelligence. Of course not. But the ones that really follow the process, absorb the knowledge of trend lines and patterns, implement it in simulation mode for a good month or two or whatever, and then implement it with the proper mindset and psychology in real trading, can do very, very well. Okay. Keep it simple, students, trend lines and patterns. Here's a couple more quick little testimonials. You're the real deal. Your sugar cubes make money. I took Dan's 4-day class. He's a great teacher and trader and human. I've attended his live trading room as well and witnessed how passionate about the market he is. Highly recommend. I do have a swing trading group since October 2020 with my partner, Maddie Fish. We got a 10-month going on, an 11-month track record now, making money every month. My partner, Maddie, is very, very patient and very selective and picky with the trades. He built a nice customized scanner at Thinkorswim that generates, he programmed it with trend line breaks and trend and candle patterns and chart formation patterns that we went over, and it just spits out a lot of winning trades. And we go 10 to 25 trades per month, all asset classes. I added a Forex and crypto specialist a few months ago, and they're building up a good track record as well. We do 2 Zoom sessions every week, one in the afternoon and then one Monday night with Maddie Fish. He goes over, we call them our strategy sessions. Monday night, they're recorded, so if you miss it, here's a couple. I have a Labor Day special going on, 2 weeks in my swing trading group for $75. So if Anna can put those links maybe in the chat, or I can do it as well if you need to. I actually have my Word document open. Let me see if this works here. Yeah, there's the Labor Day special. 2 weeks for $75 to see how we roll and to experience the swing trading group. There we go. I think that works. And I also have a class. I have a 4-night class. I have a package deal, folks. A 4-night class, 3 hours each night. I just finished it last night, by the way, the August class. The next one's going to be in middle of October, early, every 6 weeks or so. 4-night class, deep dive into trend lines, patterns, position sizing, risk management, and psychology. I record them on Zoom, so the students get the recording. You get a PDF of the curriculum. Then you get a 90-minute private Zoom session, mentoring and consulting, one-on-one private after the class whenever you're ready for it. And that is also recorded, so you get a copy of that. Another deep dive for 90 minutes, private Zoom session. And then I have a private Facebook group that's going to meet every Tuesday at 3 o'clock. Those will be recorded for an hour or 90 minutes, going over the current markets, looking for trend lines and patterns, and looking for opportunities. And then you also get a two months free in the swing trading group. So the live class for 3 hours, 4 nights a week. I go Wednesday, Thursday, Monday, Wednesday, so it's spread out. It's all recorded. 4-night class, the 90-minute live private mentoring on Zoom as well, recorded. You get a copy of that. 8 weeks, 2 months in the swing trading group for free, 2-month trial for free, and the Facebook group. And normally the whole package is $6,500, and right now until Labor Day I'm doing it for $4,500, which is a $2 grand savings. So here's that one as well. the whole package. So if you want to, I know that might not be in everybody's budget, I understand, but if you want some private mentoring, alone and maybe 1 month in the swing group or any kind of customized package for you that can help you out, that's what I'm all about. Okay. If any of this sounds good to you, you can email me some information, dan@trendlinebreak.com. My Facebook business page is LaSalle Wacker Trading and Teaching, or you can find it at Shug Trader. My Twitter handle is at TLB Trader. TLB stands for Trendline Break. I love Trendline Breaks. And then there's my website and my email address. Any questions, folks? I know it was a pretty good pace, but I'd like to set up with Anna maybe in 3 weeks or a month or 6 weeks, where I can do like a 3-hour webinar and spend some more time at some point, maybe in a month. But I like that format with 4 presenters, 45 minutes each. You get a nice little flow and different knowledge and different strategies, which is a very good format. So I appreciate Investors Expo, and Anna helped me out yesterday and helping me get ready for this. So thank you so much, Anna. I don't see any questions. I got the chat undocked. I think I see 89 people in there in the room. No questions, folks? Any questions at all? Type them in. I don't know why I'm not seeing them, if there are coming in, but I got the chat box open. If you need any questions answered, great. If not, maybe you're tired from the 4th straight presentation. I understand, folks. Yeah, that's my email address. I think these are recorded, so I don't know if Investors Expo sends out the recording, or you guys get a copy of the recording. Great. One more link. I found my link for the Pyramid to Profits PDF or PNG. Let me right click, copy hyperlink, and here's one more for the PDF that I talked about that you saw, the Pyramid to Profits. That was in the beginning of the presentation. Here's my setup. I got a 50-inch. I have 3 TV sets from Best Buy. The Insignia Best Buy house brand Insignia 50-inch high-def TV, and then 2 42s. That's what I'm looking at right now. I bought that Veridesk. Question: Is there a way to scan for setups? Well, FinViz, FINVIZ, has some pre-packaged scans where you can scan for like an uptrend or a downtrend, and some patterns. They have like wedges, symmetrical triangles, bear flags. So on FinViz, you can start for free with some basic scans. Yes, you can. Yep. And that'll help you get going, on your path. But FinViz, let me type that in. Some of you may have heard of it before. Financial visualizations, finviz.com. Very good website. A lot of information, some fundamental, technical, but they do have some prepackaged scans for trend and wedges and bear flags, etc. Yeah. So yeah, there's my setup in my Veridesk that goes up and down so I can stand once in a while. There's my bull and bear on my desk, my big microphone, my podcast mic, my hydration, big sippy cup. There's my big monster PC, my trading. I have a trading computer from one of those trading computer companies, $3,000 just for the box, but I never have to hit Alt Control Delete. So very, very powerful. And it's my second one. The first one I think it lasted 8 years. The first one lasted 8 years. All I had to do was change the power supply for $125 once. But tradingcomputers.com out of Wyoming or Montana, there's some great tech geeks that know how to put together computers, and they make great machines. And this is my second one. This is from December of 19. So this will be 2 years old in December. Yeah. All right, folks, 2 o'clock. Thanks so much. I really appreciate your time. Hope we took some notes. Again, I know we went at a pretty good pace, but great information. If you have any questions, email me, hit those links. My next class will be in October. Last thing is, if you do buy the class in the next couple of days, I'll send you the recordings from my August class. It just ended last night. So I'll send you the recordings. You can watch those and then wait until October for the next live class, and then you'll be way ahead of the curve already. So you can watch the 4-night class recording, stop and start me, and then in October, when my next class is middle of October, you can join me live, and you can do even a 2-pay. There's a 2-pay option. $22.50. Now, and then $22.50. In about a month or 6 weeks. A lot of people do that, which is fine with me. And then I'll send you the recordings and the curriculum, and you can do it that way. If not, whatever, we'll see you next time. Thanks, Anna, so much for your help. And I look forward to doing it again, maybe, for 3 or 4 hours, whatever the case may be in your format. Thanks, folks. Take care.